Welcome to our Trading Success Summit, and thanks a million to Britt. She's a lifesaver, great person. It's my honor to have Tom Sosnoff here from Tastyworks, and he's going to give us a look through the platform. Hey, Tom, one of the things I like best is first impression looking at the platform is that it helps traders visualize the parameters of the trade, in terms of where the strikes are and all that. So you guys did a great job engineering it. Anyway, Tom Sosnoff from Tastyworks, great to see you here, and take it away.
Hey, thanks, Ken. And thanks, everybody. Sorry for the couple seconds delay. We were having trouble with the screen share in Zoom. But let's just see if I can host. So, perfect. So,
and Tom, you can share your video too if you want by clicking show video.
I did.
Okay.
I did. So I threw my own, my ugly mug up there. But I think sometimes when you do live webinars, Ken, it's better to see the person talking and you have a little fun with it. So
yeah, I can see you now. Okay, good. There you go. Looking good in a red shirt. Okay.
Yeah. I'm all wrapped up today because it's like freezing in Chicago, but that's it. Anyway, so I'm Tom Sosnoff. I am Chicago based. I'm the CEO of I'm the founder of Tasty Trade and Tastyworks. And I'm kind of like an industry junkie. I've been around the block a few times, probably more than a few times, and I've been doing this for most of my life. And today I'm going to take you on a quick walkthrough. You never know exactly what you're going to do, and after the move we had this week, which I think was very surprising to a lot of us, I came in. It was a short week. Remember, Monday was a holiday, and I came into the short week thinking to myself, and I'm usually like a perma bear. I'm always leaning short delta. I'm always short premium, short delta is my primary position. And I came into this week thinking, okay, it's probably not going to be a great week to be short. This is the whole concept of nobody knows anything. And I came into the week thinking it's probably not a great week to be short. Volatility will probably contract a little bit. It's expiration. There's a massive amount of derivatives expiring in January. And the reason for that is the January leaps from, a year and 2 years ago, whatever it is, they all expire. January is always one of the busiest expiration cycles of the entire year. But the market threw us a little bit of a curveball this week, and they basically, pulled the plug, and it was a nasty 4 days, an ugly little sell-off across the board, and a pretty significant pop in volatility. As you can see, these are prices from yesterday's close. S&P's down 93, NASDAQ down 430. The Russell was only down 37, probably the strongest of all the indices. The Dow got crushed. But the most important thing, I think, is to see that on an expiration, it's really rare to see vol up 10%. In fact, I think you can go back a very long time. And on the third Friday of any month, probably going back for maybe all the way to 2008, I don't think that there was an expiration vol expansion of 10%. I'm not sure that we've ever seen that. So at least not for a long time. And then the next column down, obviously, the next future that on my screen here is Bitcoin. And the reason I left that up on the screen is because these markets are trading now. So one of the things about today's technology, which is very different than the technology we had 5 years ago or 10 years ago, or obviously 20 years ago. Tastyworks is the same team that we put together in 1999 that built Thinkorswim, that was ultimately sold to TD Ameritrade. It's now Schwab's main platform. My team built that, and we spent 10 years of our life building that. And then we went on to build Tasty and Tastyworks. And the primary difference is that Tastyworks is a high-frequency platform that encompasses a lot more speed, stability, products, and it's very conducive to trading. Our goal is to facilitate opportunity, whatever that means, to whoever that means. So we don't have any limitations on like what you can do and like the size of your account or the type of your account or the products you can trade or the strategies. It's all open. It's all open game on Tasty from our perspective. But the reason I started this discussion today because like I said, I'm Chicago based. Saturday morning, it's 11:07 Central Time, and in years past, we're closed right now. I mean, there's nothing you can do. But as we get into the world of decentralization, and as we get into the world of what I think will be tokenized globalization, you have a lot of speakers today, a lot of really smart people that have also been around the block for a while. But one of the things that you're starting to see is there's a lot of new exchanges, there's a lot of new products, and there's a lot of what we call kind of new digital or new tokenization. And one of the things that Tasty does that no other firm really has is we truly support all products. So not that we try to compete with Binance or FTX or Coin, or Crypto.com or that kind of stuff, because we're not a pure crypto platform by any stretch. 80% of our business is listed options. 20% of our business is a little less than 80% is listed options. A little less than 20% is futures and futures options, and a little less than 1% is stock, and about 1 to 2% is crypto. But the reason I brought this up is, like you can see this morning, I'll show my cursor right now. This is the lowest Bitcoin's traded in quite a while, and I personally think Bitcoin's going a lot lower. I don't think it's going to hold here at 35. In fact, I think it's going to break 20,000. But the other side to me says, hey, you know what, Tom? You've got to buy. There's not a lot of strategies doing digital assets. So I like buying on the way down, because I'm not really a person that likes to dollar cost average, but I am a person that likes to trade. And it has gotten to the point where, listen, 35 is way better than 65. So I typed in, this is cash Bitcoin, by the way, not futures. We offer futures in Bitcoin. We also offer futures in Ethereum, which means if you want to leverage digital asset product, that's cool. And if you want to write calls against a leveraged digital asset product, that's cool too. But if I wanted to buy, let's say $500 worth of Bitcoin right now, just typed in 500 here and double click on review and send, there, I just bought 500. Hopefully you can hear that. If I go over here, this is Ether, and Ether traded all the way up to 4,400. It's now 2,400. So I'm starting to buy a little Ether as it drops. So I'm going to buy, let me just move this little slider over. I'm starting to buy a little Ether. So just bought $500 worth of Ether. Now I'm going to go over here to 88 Cardano. So I'm a huge Charles Hoskinson fan. He's the founder and CEO of really the creator of Cardano. And so you can see up here, this is Cardano 88. And I'm starting to accumulate a position in Cardano. And again, I'm doing this because I think it's important for you to see that in the world of what's about to become secure tokenized trading, and then I just bought $500 worth of Cardano. I'm going to go down here, and one of my favorites is Polkadot, and Polkadot's down to under $20. It got up as high as well over 30, almost to $40. And I'm going to do the same thing in Polkadot and buy $500 worth of Polkadot. So that's a very small amount of notional digital assets for me to buy $2,000 worth of digital assets this morning. But I'm buying into these dips. Obviously, this is the lowest it's been for a while. And I'm showing you that in 2022, we go 24 hours a day, 7 days a week, which is super cool. And on Tasty, unlike any other platform, if you're on TD, Schwab, Fidelity, E-Trade, Interactive Brokers, anybody else, nobody offers any cash digital assets. We offer 21 right now, and we're adding 5 more in the next week, hopefully, and Solana is one of them. We also offer digital gold. So in other words, secure tokenized secure gold. So if you want to trade gold 24 hours a day, this is what we call Pax Gold. So let's just say, for example, I wanted to buy, I'm just choosing this as an example, $100 worth of physical gold via secure token. Just click on it, take a fill, and done. 24 hours a day, 7 days a week. The facilitator of opportunity, this is what's so cool. Now, there's no options to sell against this, and you can't short these products right now because they're not technically securities. This is like what we call a spot market or a cash marketplace. But what's cool about this is what Tasty does. We don't care what you do. And so, when I'm trying to give a software demo like we are trying to do right now, I'm going to go back and take you off of this crypto page, go to a classic table mode, and just show you some other things that like kind of, that are part of the crypto space. And I'm going to get into other things, but since it's Saturday morning, it's cool to show you this because very few people will. So this is /MET is the CME's micro Ethereum product. Now, the reason I put this up is because if you want to trade Ether and you want to just start to accumulate a position, this is a way you can do it with this contract size is only, now this came out a couple of weeks ago, it was about $350 a contract, which is 1/10 the size of this. Now it's down to $260, and you only have to put up 50% or 130. So you can control $260 worth of Ether with only putting up 130 in the futures world. And this is what we call a micro contract. Now it's not open right now, but it is super cool. And again, offered on the Tasty platform. Or if you choose to, you want to choose micro Bitcoin, you can choose micro Bitcoin, which is 1/10 the size of this, which is a $3,600 contract. Okay, 1/10 the size of a Bitcoin contract. All of this on the Tasty platform. But let's just say, you know what, you wanted to buy some Bitcoin, but at the same time you wanted to sell some calls against it. So you went to a stock like Mara, which has about an 83% correlation to digital assets and to Bitcoin. And you went out to March, let's say, because the IV rank is high and the implied volatility is 120 in March. And you went out to March, you said, you know what, usually digital assets trade at 4 times the implied volatility of the S&Ps. Right now, it's a little bit less than that. It's like a little over 3 times. But if you wanted to go out to this, stock's trading at 21 with an 80% correlation to Bitcoin. The nice thing about today's kind of optionality and what's available to you is you could theoretically go out and 100 shares of Mara would be the equivalent of $2,200. So you could buy $2,200 in cash Bitcoin and then go out and sell, for example, like a 25 call against it just by clicking on the bid. It's not cross marginable, but what you have in that case is a covered call in digital assets. With, if you're bullish on Bitcoin or Ether or anything else, you could essentially set up a covered call with a non-leveraged underlying against a levered call with, again, 120% volatility to give yourself a high probability trade, which no other firm will let you do. Even better, you can go back to /MET, which is micro Ethereum. And in this case, if I wanted to, I could buy a 9 lot of these MET micro Ethereum. I only have to put up just a slightly over $1,000. And then I can go back to Mara and I can sell one of the 25 calls. And in effect, I have a perfect, totally leveraged covered call, putting up 20% in Mara, putting up 50% in micro Ether. And I have a covered call in Ether with an 80% correlation between the call I wrote and the underlying digital asset. And effectively, I've created a digital asset trade with a mathematical chance of success of about like 63% versus a 38% chance of losing. And that's if you're bullish on digital assets. And that's the coolest thing about 2022 is technology. And again, this is really only on Tasty, but you can do it on, maybe there's other platforms that you can do it on, combination stuff. I don't really think there are right now, but I don't want to rule out everybody. But you can't, like, for example, Robinhood will offer digital assets, but they won't offer futures. So you can't really do it. There's no underlying to do. And on Tasty, you can create these combination of trades or pairs trades or whatever you want to call them. But it's essentially a digital asset, like not necessarily arbitrage, but it's like a digital asset customized spread with a high probability of success. Listen, this is a fascinating market. We have high implied volatility. We have many, many, many prices that have come significantly off their highs. I mean, the market's still at nosebleed levels, but it has come down a little bit. The Nasdaq's come down what over, I think, 10-12% already this year. But the market is still at, was up gigantic last year. So we're still at very high levels. But there's a lot of stocks that have been crushed. So there's a lot of really interesting plays out there on companies that, they've gone, they've come down 60, 70, in some cases, 80%. When you're talking about stocks like Peloton, you're talking about stocks like Pinterest, you're talking about stocks like DraftKings, you're talking about stocks like Zoom and Square and DocuSign. And, these are gigantic moves off of highs, but they've come back into ranges right now where they're going to be tradable for a long time to come. Now, it's unlikely you're going to see highs again, but who cares? It's really interesting that we're getting to the point where, things have become, we've normalized. Things have become more tradable. This is cool. So let's take a look as we start to head into a very tight earnings cycle here. Let's look at we obviously had a crazy move on Friday in Netflix, but actually let's use Netflix as an example here. So I'm going to type in Netflix. So Netflix moved $110 on Friday after earnings. The expected move was about $36. So it basically moved 3 times the expected move. That is a legit, that's basically a 3 standard deviation move, which has about a 1% chance of happening. You can't play for an outlier move. There's no textbook for playing for an outlier move. But what's interesting is once you've had an outlier move, the question then becomes, how interesting is this stock? Well, let's take a look. So the implied volatility in Netflix right now, post earnings, is 71%. Is at 71. That's the rank. That means on a relative basis, from 0 to 100, this implied volatility right now in Netflix, this number right here in March of 50%, is its rank is 71 or 72 out of 100. That's incredibly high post earnings. In fact, we've almost never seen a post earnings implied volatility that high of 72 post earnings. What's also interesting is that the March expected move, and now there's 55 days to March, but the March expected move is almost $48. So what's cool about Netflix is if we open up kind of March options here, and we have a great crowd today. So again, my name's Tom Sosnoff, and I had the pleasure of leading off today's summit. And so thanks to Ken and everybody else that love doing these. It's a Saturday. I wish I could talk for 3 hours. We could have some fun with this. But the Netflix closed at, you can see right here, closed at 397.50. After hours, it was a little bit lower, but the expected move is about 40. The expected move in March, you can see right here, is plus or minus 51.70. What's neat about that on Tasty is we give you the IB rank right up front. Nobody else does that. That puts context around this implied volatility number of 49%. That is the at the money implied volatility, which is a kind of a VIX style smooth skew at the money implied volatility. And I'm talking to you at a very high level today because I don't like dumbing anything down. And the expected move is $51 over the course of the next 55 days. What's important about that is that gives you context about where to set up your spreads. So if you think, okay, this is a crazy move in Netflix, and now it's going to sit here for a while, and let's say you want to do something, you would take 397 where it closed, and you would go, let's just say, at least $50 lower. So let's go $55 lower, and let's take this down to 340. Okay, that is just outside the expected move, right? $55 minus 396 takes you down to 340. And on the upside, let's move this up to, let's add $55 to 396 and takes you up to 450, all right? Right here. So as you can see, this is about the 25 delta call. That means there's a 25% chance of getting there. This is about the 19 delta put. You're always gonna have a little bit of more call skew in here. And what we're looking for in this would be a short strangle. This is a completely non-directional trade, but it costs a lot of money. It would be for a one lot, it would be about $8,000 because it's about 20% of the stock price, which is $400. So one contract would be about $8,000 in margin requirements. That's not set by us, that's set by the regulators. But let's say you want to put a position on here. The cool thing about Tasty is you can do anything you want. You can start with the short strangle, and then you can say, you know what? I'm going to buy this call, this put down here. I'm going to buy this call up here. Now I'm going to turn it into an iron condor. And because the stock's already dropped 110 yesterday, I'm going to just drag the put side down one notch, and I'm going to have this spread on, and I'm going to do a 10-point wide put spread and a 5-point wide call spread. Or, you know what? I'll just do 5 points on both sides. And then I'm collecting exactly 1/3 the width of the strikes, which is about 360, which means I have about a 67, somewhere in the range, statistically, of over 60%, but close, a little, probably like 62% in that range, probability of profit. But then down here, we run a Monte Carlo simulation and we run all the theoreticals for you. So the probability of profit, just based purely on the implied volatility, is 57%. And the probability of making 50% of max profit, which is half of this 365 number, is 74%. And when I said it's flat, the delta on doing this trade, if you were to do one contract, is less than 1 share of stock. So there's no directional risk. And if you were super bearish, you could remove the call side. If you were super bullish, you could remove the buying the put leg. This turns this into a jade lizard. The beautiful thing about Tasty is you can drag these. If you wanted to add more credits and you wanted to take more risk, you can drag them however you want. I mean, the great thing about our platform is that you don't have to type in anything. All your Greeks are down here. And if you wanted to see, like Ken mentioned before, if you wanted to see kind of what this looked like in a curve mode, we'll show you right here. So we'll give you, this is not an analysis tab. We have that too. I have so much to show you, but I only had 30 minutes to talk, so I can't get into all the stuff. But I made 4 crypto trades and then taking you over to look at a Netflix Iron Condor, but started off with these two, which is a short strangle, added the long wings, turned it into an Iron Condor. I can remove one of the wings, turn it into a jade lizard. I can do anything else. I can skew the strikes to make it into a skewed Iron Condor. And then I can show you a visual of this. This is your distribution curve. And this is where you lose. This is where you make. This is where you lose. This platform has the most advanced technology in the world for retail investors. And it's the only platform in the world built on high frequency middleware, which means it's crazy fast, stable and fast. But, again, I'm only giving you just kind of like an outside peek because it's, because the timing. But here, take a look here. This line here is your 1 standard deviation move. And down here, this is your 2 standard deviation move. So it's all built in. This move here is your expected, this is basically your expected move. So it's also built into the trade thing. So you can see kind of what that 55-day expected move is. The platform is designed to give you as much quantitative information, probabilistic information, statistical support for what you're going to do. We don't try to push you in any kind of direction. We try to give you all the context and content that we can. On Tasty, there's the small chart up here. We're not technicians, but we do put a small chart here, and then the layout stays the same regardless of what you trade. So there is charting on the platform. This you can see is the down move. There's actually multiple charting platforms on here. This one is a different layout, but you can type in whatever you want. One of the nice things about Tasty is that if you want to see, for example, all the trades I made on Friday, and anybody that, if you're smart, you probably don't want to see all the trades I made on Friday, but they're all listed right here on a follow tab that we have. So I show everything I did. I probably made 100, I don't know how many trades I made, a lot. And we also give you access here. Hopefully this doesn't, I'm not going to show you this because it may crash the system. It already did. On Zoom sometimes when you, oh, bummer. I should have known better. On Zoom sometimes when you try to click on a interface for the web, it may crash. You can access Tasty Trade on there, which is our financial network, which is the largest digital financial network in the world. So this is kind of a very quick, rough overview of what you can do on Tasty and the context that's built into that. With respect to the markets, as you can see, we build our whole platform off watch lists. So, for example, this is a futures watch list, but there's plenty of stocks in here as well. We just kind of gauge what the market's doing off of this. One of the other nice things about Tasty is we are one of the only platforms that support the small exchange. So we have all the small exchange futures built into this platform. That's what all these are. Um, we also allow you, when you open an account with us, when you click on the works, you will get the access to every product. So there's no, you don't, like, it's not a platform where you can't trade this or can't do that. You can use any product, any strategy, anytime you want. And the cool thing is, we also just wrote a book. And when you open an account with us, you will get a copy of the book when it goes live in March. And this is a brand new book called The Unlucky Investor's Guide to Option Trading. And it was written by a woman that works for us named Julia Spina, who is absolutely, I mean, I'm just telling you, she's freaking brilliant. And she's only 26. She's a physicist. And a lot of the tasty mechanics are built into that. And it is going to be a book that changes a lot of the dynamics about, what people think about trading derivatives, trading options, and how all this stuff kind of works and fits together. And we're super excited about it. Ken, I have, I don't want to bogart anybody else's time, as we would say. I know you have a great crowd today. I know you have a bunch of great speakers. I only wish I had another hour and a half. Because seriously, I got so much to talk about this week. It's crazy, but you've got some amazing speakers coming up, and I really appreciate the opportunity to get in front of, your clients and your user base, and so thank you so much.
Well, thanks so much for being here, Tom. I appreciate it. And be sure, everybody, to watch Tom's first call Sunday afternoon on YouTube. I do. Always good to see Tom and crowd.
Yeah, I mean, we do start on Sunday night at 4:55, and it's first call, and then we start the shows Monday morning again. And remember, the platform's open all the time.
Hey, great thing. Let's do a quick question. What's the minimum account size to open an account with Tasty?
That's $2,000. It's the FINRA minimum for having a margin account, $2,000.
Okay, that sounds good. Yeah, I like the fact you can buy Bitcoin. 28 and below is my target to get into BTC. So anyway, thanks, Tom Sosnoff. Yeah, I wish I could listen to you all day, man. You're brilliant. So great platform. Highly recommend it. Let me see if I can reclaim host here. And let me see if I can change this over to Larry Mcmillan. Let's see if I can get this right.
Well, I stopped sharing.
Okay, let me make... Okay, Larry, good to see you here, and I will switch it. Thanks, Tom. Let me see if... Larry, can you share your screen? If you click on share screen, hopefully...
Yeah, I'm going to attempt that. Okay, here we go.
Okay, now thanks, Tom. It's always an honor to have you here, man. I highly recommend you and your whole platform and your entire company. You're brilliant. Next up, we've got one of the world's top options experts, Larry Mcmillan. It's great to see you here, Larry. I always pick up new tips from you on the VIX, so interested to hear your take on that and more. So take it away, Larry Mcmillan, for our live event.
Yes, pretty interesting right now in the market. It's about as interesting as it can get. So we're going to try to answer the question, is it time to buy, by going over our various indicators here. Just a little background. We started out as a derivatives research firm 30 years ago, moved into money management after the 2008 financial crisis. And then we also do a certain amount of educational things like this, or mentoring. At this URL here, we are going to be offering discounts on our products. And the PDF of this talk will also be there for downloading. Okay, so this is the complete set of indicators that I look at. The ones I try to color code them a little bit. So this is S&P kind of indicators. These are put call ratio indicators. These are breadth indicators. VIX is the gray boxes here. Realized volatility, and then VIX derivatives. So we'll try to run over most of those. The most important rule, especially right now, is that oversold does not mean buy. So a market can get oversold and stay oversold for a long time. If you try to buy it just because it's oversold, you're probably going to get run over. Mostly referred to as catching the falling knife. Doesn't work too often. Conversely, overbought does not mean sell either. We don't really have any overbought conditions right now. So this is a 2-year chart of the S&P. And I just, the biggest decline on here, of course, is the pandemic. I'm just going to point out where it first got pretty oversold, about right there, right on the first trading day of March. So that decline started at the end of February. That last week in February was really terrible. And we had, entering March, massive oversold conditions that persisted all the way down to the bottom. So that's just a classic example. Right now, we've only fallen about 8.8% from the extreme highs. We have touched the 200-day moving average for the first time since June of 2020. And we're looks like we're heading to test this support level at 4,300, which was the September lows, off of which we did get a nice strong bounce. And so we'll see. But we have broken the December lows, which is right here. And that's a bearish sign. And if you look at Stock Traders Almanac or some of the longer term systems like that, that is typically a sign that we're entering a bear market. Not always, but often. So in addition to just looking at the chart of S&P, we draw modified Bollinger Bands around it. And by modified, I mean that we use the Black-Scholes definition of realized volatility rather than the one that John Bollinger used when he created the Bollinger Bands. So we look for a move outside of plus or minus 4 standard deviations. And then once that happens, a signal occurs once it moves back within 3 standard deviations. So here's the current chart. And you can see, for example, here last September, this wiggly line here, that's minus 4 sigma. And the one inside it is minus 3 sigma. So you can see we moved outside of minus 4, back inside, and that was a buy signal. The market did go a little bit lower, but then took off and hit the eventual target, which is the plus 4 sigma. So we had a sell signal in November, which took a little while to get going, but did succeed eventually. And now here's the minus 4 right here, and we're below that. So a buy signal is setting up. It's probably not going to happen immediately. And under what we call Mcmillan volatility bands, we need confirmation of that first buy signal. But just in case, on Monday, if S&P closes above 45.02, which is possible, then you would have the first part of the buy signal in place. So right now, we're very oversold. But again, remember, oversold does not mean buy. So I guess one other thing I wanted to point out on the chart here, the 20-day moving average is up. I just lost my toner there. The 20-day moving average is just above 4,700, and so that's here we go. It's right here. In an oversold market, even a bear market rally can rally back to the declining 20-day moving average pretty easily. And so that could be a target. It seems like a long ways from here. It seems like that would be sort of the end of bearish sentiment if that happened. But in reality, this market is just so volatile that that move would be nothing more than just a retracement of an oversold condition. So an oversold rally could take you up to, say, 47.05. It wouldn't really change anything. Breaking 4,300 on the downside would again be another big negative for this market. We do offer the Mcmillan volatility bands on all stocks, futures, ETFs, etc. If you're interested as a subscription service, you get an email telling you where the signals have occurred each day. So let's move on to the next topic, which is put-call ratios. And to predict the broad market, we use the equity-only put-call ratio, which is all stock options that trade. There's a lot of those. The put-call ratio was identified as a contrary indicator by Marty Zweig back in the 1950s when he was getting the data from the ads that ran in Barron's from the put and call dealers in that day. So essentially, we look for local maximums and local minimums on the put-call ratio chart to give us a signal. So, for example, the local maximum is a buy signal, And that was a pretty good buy signal right there. So we came into the end of the year. We were on a sell signal until mid-December. We caught this last rally, and somewhat surprisingly to me, we quickly turned around and went back to a local minimum and hit a sell signal right at the beginning of the year. So we're still on that sell signal. This is the standard ratio, which means we're just looking at option volume here, puts versus calls. And it started to accelerate to the upside, but wherever it goes, it won't be a buy signal until it rises and rolls over like that. Now, we also measure the dollars being spent on puts versus the dollars being spent on calls. This is what we call the weighted put call ratio, or the dollar weighted put call ratio. And it's more extreme, you see. You see here that it has already risen to the highs of the year, so it's extremely oversold. In fact, these are the highest levels it's been since March of 2020. And again, though, just because it's oversold doesn't really mean all that much. I mean, yes, a buy signal will set up from here eventually, but it's going to have to roll over to create the buy signal. So that's not going to happen immediately either. So just to summarize those, this has a long and positive history, these put call ratios. So we have the long-term track record in the Option Strategist newsletter. But those buy signals in December were quickly reversed into sell signals now. And just yesterday, we had the single day reading across all American exchanges, option exchanges, was 88, meaning there were $88 being spent on. Oh no, I'm sorry, that's just a straight equity. 88 puts traded for every 100 calls, which is a very large number. That doesn't usually get that high. The CBOE put equity only put call ratio was 82, also a number it doesn't get to very often. So things are getting extreme. But there's still danger in this market right now. What do we trade when we get a signal? Well, I like to trade a slightly in the money option with a delta of 70 or higher. That way, I'm in the business of predicting where the underlying is going when I'm doing these speculative trades. And I want the option to be responsive to that. I don't want to be right on the underlying and having bought an option that's way out of the money, overpaid for it with a small delta, and find that the option didn't increase, even though I was right on the stock. So if we're going a little longer term, which I call intermediate term, which is probably about 3 months for me, I might buy an at the money option. Otherwise, I'm buying in the money options. Now on TV, if you watch the option shows or ones that specialize in options, they always seem to be doing a bull spread or a bear spread. They love the spreads. I'm not sure why. We don't have time to go into the option theories, but basically, if you are if an implied volatility is normal, then there's no advantage to a bull spread. They say, well, it costs less, but it doesn't really cost less, because the only time you really want to use a bull spread is if implied volatility is high. Now, VIX is high right now. It's up around 29. So if you're trading a SPY spread, sure, it makes sense now to do a bull spread or a bear spread. But in reality, in a normal average market where implied volatility is average, you don't want to cut off your profit potential by selling that other option up there, call in a bull spread. And the risk is 100%, whether you bought a call or you bought a bull spread. So to tell me that you're risking less, I mean, that's not true at all. Yeah, dollars, all right, you can adjust dollars. Instead of buying 5 calls, or say, instead of buying 5 bull spreads, buy 3 calls or whatever. Keep your dollars the same. But your risk is 100% in either position. And I found, especially when volatility is normal, big moves are much more likely to come out of the blue. And you want to be there when the big move happens. And if you've cut off your profit potential by selling that other call, then you have a problem. But when options are expensive, as they are now, and we're trading a lot of SPY spreads in our newsletters, then we do a couple of things. First of all, you can widen your strikes between the two. If you're buying a call bull spread, for example, you want 13 to 15 points between your strikes. But if you're buying a put spread, and in SPY and SPX, the out of the money puts are much more expensive in terms of implied volatility than the out of the money calls are. So here on puts, you want your strikes to be 25 to 40 points apart. So very wide. That helps you minimize the problem that happens if the market moves so far that you hit your short strike. But if you're in a bear put spread or a bullish call spread, if you hit the short strike, now you're pretty much run out of profit potential. Yeah, there'll be a little bit left, but not all that much. So when that happens, we rolled the whole spread. So, if I like this yesterday when we had some basically put spreads on, we were long the 470 puts in SPY and short the 445 puts. We hit 445, so we sell the spread and we buy a new one. We buy 445 puts. We went out a couple of weeks, and then we sell the 420 put. So we roll the whole spread down, and that helps also to minimize the damage from that short or the profit limiting characteristics of that short put. Individual put call charts. I'm just going to show you a couple here. This is one we just recommended yesterday. And you can see it was very extreme here. This is a weighted chart, meaning we're looking at dollars. And so basically it was around 27 on this scale, meaning that only $27 was being spent on puts for every $100 being spent on calls. So that's a very low number. You can see it's the lowest number on that chart. So that's overly optimistic by traders, and the local minimum here gives us a sell signal. We have broken down, as you can see. So we are buying puts on this without conditions on them at this point in time. Just one other one. Last week we moved into EVRG, same sort of thing. Here there was a little support level. We waited for that to be broken, which it was this week, and so we're buying puts on that as well, or we're long puts on that. Market breadth is another very interesting characteristic of the market right now. So breadth is just advances minus declines. You can keep a cumulative total, or you can keep an oscillator. So the oscillator, the way we do it is today's oscillator value is equal to 90% of yesterday's oscillator value, plus 10% of the difference between today's advances and declines. So there's two data sets here. One is the typical New York Stock Exchange data set, which has a lot of things on it that are not stocks. It has a lot of preferred stocks. It has other interest rate related issues. And so they distort the advanced decline line. But we also compute the similar data on what we call stocks only. That's all optionable stocks. And there's a lot of optionable stocks now, well over 6,500, because they keep adding them as when the SPAC craze was going wild, they were adding, 5 stocks or so almost every day, sometimes more. Anyways, this is the oscillator, the stocks only oscillator. And it goes on this chart back to 2013. If it gets below minus 400, that's oversold. That's these green areas. You can see that this was the most oversold it had ever been. That was Christmas of 2018, that terrible market right before Christmas. Then this was the pandemic low in March of 2020. Surprisingly, this last December, the selling in the beginning of December at the end of 2021 was stronger than a lot of people realized. And so we got down there very oversold. Here's where we are right now as of last night. Same level almost as that. So extremely oversold. We don't buy on this indicator though until it stops being oversold. So we don't buy until, let's say, here. So you miss the absolute bottom, but you still get in, say, here, and you've got plenty of room to run. So here there was a buy signal on December 20th. We got oversold and came right back out. It gave us a sell signal on January 5th, and that's where we are today. So we're on a sell signal. We're very oversold, and we won't actually cancel that sell signal out and return to a buy, though, until this improves. So it's going to take, I'd say, even if you had positive breadth for 3 days in a row, that might not quite do it, but it probably would. But 1 or 2 days, no, that's not going to turn this thing around. So the market could go up for a couple of days. This would still be on a sell signal. But very oversold, and you can see that historically the very oversold conditions have resulted in good trading moves after that. You just never know. You don't want to step in front of the freight train on March 1st, 2020. You wait for the turn. So just to repeat those things, and by the way, this is the most oversold this thing has been since March of 2020, which is what we just saw there. So new highs versus new lows. This is 52-week highs and lows. And you can see we follow 3 data sets here. The one is New York Stock Exchange. The second is stocks only. That's the same optional stocks. And then this is NASDAQ Composite, all the stocks in the NASDAQ Composite. New York Stock Exchange and NASDAQ Composite data is reported on Wall Street Journal website every day. You can pick these numbers up from there. Just look at the last few days. I mean, that is carnage. You know, eight new highs in the New York Stock Exchange yesterday, 525 new lows. On NASDAQ, 22 new highs, 1,300 new lows. So that's bad. But what was really crazy was up here at the beginning of the chart, SPX was making new highs here. And within a couple of days, you had hundreds of stocks making new lows. So, you know, SPX is within a small percentage of its all-time highs, and yet hundreds of stocks, 600-700 stocks are making new lows. That's not a good picture. And that's what's been happening in this market since last June. A lot of internal deterioration. And it's not over yet. This would actually turn back to a buy signal if you had more new highs than new lows for 2 days in a row on the New York Stock Exchange. It seems impossible now, but it can happen pretty quickly, you know, especially on New York Stock Exchange, where it's got these interest rate related issues. So let's talk about volatility for a minute. Volatility is VIX, which you cannot trade, and then VIX futures and options, which you can trade. So first we'll look at VIX as an indicator. There's 2 things that are important. One is the trend of VIX should be trending opposite to the market. And the second is spike peaks in VIX are buy signals. So here's the current chart of VIX. All those B's are a buy signal, a spike peak buy signal system that we have set up. The red ones are successful trades. The blue ones are losses, but generally quite limited. There was a trade here from early January. So it's already been stopped out. And so now VIX is racing higher and it's spiking. That's in what we call spiking mode. Eventually it's going to come up here and spike back down and give us a new buy signal. This will probably be the first confirmed buy signal we get. And I would expect it to happen next week somewhere, but it might not. I mean, in 2008, it went to 90 before it really turned. I'd had a couple little fake outs along the way, but you know, just buying because VIX is at 30 or 29, that's an insufficient reason. Now, I mentioned the trend of VIX. Right here, the trend went negative back on December 1st. So what I mean by that is the 20-day moving average, which is this line, and VIX itself, which is the bar chart, crossed above the 200-day moving average, which is right here. And you can see that they've stayed there. I mean, you know, the 20-day came back, never crossed below. VIX did go below, but not both of them. So right now, the 20-day is higher than the 200-day, and VIX is higher than the 200-day. As long as that's the case, this is an intermediate term sell signal for the stock market. When that sort of thing happens, there's a potential for VIX to go much higher and the market to go much lower. Frankly, I would not expect to see that immediately, but who knows? So again, oversold conditions, no buy signals confirmed. There was an interesting thing going on. VIX is based on SPX options that trade on the CBOE. They're the most expensive options, and therefore they're the playground of the big money. And I'm not saying big money is smart money, but big money was worried about the market really all the way along since the pandemic decline. So VIX has never gone back below 15. Now, if you go back and look and say when we had a roaring, I mean, SPX started making new all-time highs, I believe, around August of 2020. It has made, I don't know, probably 100 of them since then. Maybe that's too many, but 50, whatever. VIX would normally go back to 12 or 10 when that happened, but this time it didn't. And some people were saying that concerned them, that this big money was found it necessary to keep buying protection even though the market was going up. And it turned out the big money was right. I mean, we see now that they were. So personally, I like a volatile market. I like VIX to be high. So that was always fine with me. But just as a subjective basis, it was trading higher than normally it would have, with SPX making new highs. So I said you can't trade VIX, but you can trade VIX futures and options. So we can get some information out of the VIX futures too. We can look at their term structure, you know, the relationship of the short-term futures versus the longer term ones. So without going into a long explanation as to why, in a bull market, the term structure of VIX slopes upwards like this. So the near term is low because volatility is low in a bull market, and then it slopes higher out here to say 3 years out where we don't know what volatility is going to be. So that's just an average number. But in a bear market, it looks like this. This is still the same place because, again, still we don't know where it's going to be in 3 years. But this has jumped up now much higher because of the volatility in a bearish situation like right now. So the term structure slopes downwards. So when that happens, it's a big warning sign, and we're right on the verge of it right now. So these are, again, prices from last night. VIX closed at 28.85. The Feb futures are the front month futures. Now they're also weekly futures. I'm not showing them on this chart or this table, but the front month is 27.40. And you can see that that's a discount. So if we subtract VIX from the price of the front month, we get minus 145. These are all at discounts. That's not good. That's negative for the market in general. You can see the term structure, though, is kind of flattish. I mean, it rises a little bit, then kind of falls. It's, you know, it's, I wouldn't say that's a clear rising term structure. What is potentially dangerous, though, is that the front month now is the most expensive over this, and especially over the second month. That's something we watch for. It's only 41 cents there, so that's not a huge problem yet, but I'm going to talk about that more in just a minute. If you don't have that, well, first of all, the CBOE website, the CBOE futures website, has delayed prices on those futures. But the CBOE publishes these indices, cash indices. So volatility, VIX is a 30-day, but they publish a 9-day, a 3-month, a 6-month, and a 1 year. And that term structure is kind of muddled right there too. It is sort of interesting to note that 1 year, 1 year options on the SPX are trading with a 30 implied. That's a big number. So indicate to you probably if you sell some of those, you might be happy camper eventually, but you would have to hedge yourself. In any case, so just looking at the current situation, the overall term structure, I think, has turned a bit bearish because of those discounts on the futures. But what we're really looking at here is this relationship between February and March. And it's currently at minus 41, not 40. And that's a little bit dangerous. But if it settles, if it closes below -1, that's a big problem. And you definitely need to take bearish portfolio action, whatever you're doing in your own portfolio, until that situation goes away. So we also have a sell signal from historical volatility, realized volatility. It had gotten very low when the market was rallying in early November, but then it started to rise, and we got a sell signal from this indicator on November 26th. And it's still in place. So because implied or realized volatility, it ticked up a lot, it backed off a little, now it's ticking higher again. And you know, an increasing realized volatility is not good for the stock market in general. I'm going to end with just a mention of a couple of seasonal patterns that are coming up. Right now, we're in a pattern I call the January. It's not just me. It's called the January Defect, and that's where the market typically, especially the Qs, but the market itself declines between about the 8th. You enter the trade between the 8th and 12th trading day of January, and you exit the trade on the 18th trading day of January. So that has a historically downward bias during that period. Obviously, this year, it's more than just a little bit downward bias. It's quite a bit. It's probably too late to get in that one. but this is coming up. So this is a very positive seasonal trade. You buy at the end of the 18th trading day of January. Again, that same one we just looked at. So that's January 27th, next week, Thursday. And then you hold for 4 to 5 days. What's happening here to make, if you need a reason for this, is that institutions get a lot of money at the beginning of the year. They invest some of that. That's why usually you get this blip upwards in the first week of January, and which led to that first 5 trading days indicator, blah blah blah. I don't, I'm not into 1-year indicators, but then as you get towards the end of the month, they don't want to show a lot of cash on their balance sheets for their reports, so they invest the rest of the cash typically right around the end of the month, and that's what's happening here. So in the last 36 years, that's been 28 wins and 8 losses. On average, it's been about a 1% gain for S&P. I mean, today, 1%, you move that in 20 minutes, half an hour at most. So I would expect a bigger move this year. And if you trade it with options, of course, if you're wrong, you just can lose what you pay for the options. So don't overdo it. But if the volatility reflects itself on a positive way in this, and by the way, we have similar trading systems during 2008 and 2009, and they worked very well, even though we were in a monster bear market at the time. This same sort of thinking still happens amongst the institutions. So where's that leave us? So we have no bullish indicators, none. It was not a buy signal in there. We have a pending buy signal coming up from VIX when it makes that spike peak, and we have the seasonal pattern I just described coming up next week. We have the rest of these are in massive oversold states or in outright bearish sell signals. So to me, that's not a bottom. Too soon to buy. I want those things that are in those 2 rightmost columns to roll over to be buy signals. And believe me, I'm not going to catch the absolute bottom, but I'm going to have some very good trades on the upside when those signals confirm. I had mentioned this area on our website. You can go to get the PDF of the webinar, and you can get these discounts on our products. This new home study course we created last year. Those are our newsletters. Our track records are up on the website. And since we are registered as a CTA and an RIA, our track records are, we'll say, honest. And we have a YouTube channel and a couple of other newsletters. So that's my contact information. And let me shoot it back to you, Ken.
Well, thanks so much, Larry Mcmillan. Great to see you here, and a really good insights and analysis. I appreciate the tips, especially coverage on the VIX. So thanks so much. I appreciate it, man. It's always good to have you in these.
All right. Thanks for having me.
All right. Thanks. Well, since we have to move right along, let me jump into our next presentation with Barry Burns. Let me go ahead and... Barry, how are you doing? Are you out there?
Hello, Ken. I am out here.
All right. Now, just a quick administrative note. I'm going to make you the host because I'm still trying to figure out how to use Zoom. So please don't leave the event right at the end to let me reclaim the host before you do so, okay?
Okay.
I will make you the host, and you should now be in charge. Anyway, it's great to see Dr. Barry Burns here from Top Dog Trading, often rated one of the top, or if not the top educators out there. He's got a really good way of looking at the markets, and I like his thought process. He's got a very good integrity of his process. The way that Barry thinks about the charts and the step-by-step techniques he teaches are very good as well, so I find it very valuable. So Barry Burns, take it away, and thanks for being here, man.
Well, thank you, Ken. I appreciate that, and happy birthday, by the way.
Oh, thanks. And you too, coming up, right? So
yeah, my birthday is it was 7 days away. Yep, I'm gonna be 60 years old.
Right.
Sorry, a little static there. That was totally unintentional.
Yeah.
All right. Well, I appreciate your invitation. Thank you so much. And I'm thrilled to be here. Great presentation by Larry as usual. And yeah, thank you, by the way, for putting together this whole event. I know putting together an event like this with people whose schedules are busy is no easy thing. And you did it, and you keep doing it. And these are just awesome. I was happy to promote it to everybody that I know. And we got a lot of people here. So on a
Yeah.
Saturday, that's fantastic.
Well, it's great having good people. That's the thing. There's a lot of multi-speaker events, but most of them suck. So I like doing ones that actually have good people like yourself and the other top names here. So it's a privilege to have you here, and thanks for being here, man.
Yeah, well, you do have top names here, and that's impressive. That says a lot about you that, top named people are associated with you and want to work with you. So, yeah, you got the best of the best here. So, anyway, well, let's jump right into it because I know our time is limited and I want to get done on time, and I will. So, today I'm going to talk about how to trade pure price action. All right. And a little bit about me. There's my ugly mug. And I wrote the book Trend Trading for Dummies by Wiley and Sons, part of this famous, can't even talk today here. Okay, part of the famous dummy series of books that you probably heard of. And I get Reader's Choice Awards for my trading courses from Stocks Commodities Magazine every year, fingers crossed. Hopefully we'll get an award this year too. Help other authors with their trading books. And I've done, oh gosh, seminars for Ninja Trader, the CME, eSignal, Metastock, on and on it goes. I don't want to talk about myself too much because I've only got, 25 minutes, but do want everyone to check out my free stuff. I've got a trading podcast, so feel free to type in Top Dog Trading into the search bar of your podcast platform, whatever it is, and pick up some free trading episodes there. Also on the YouTubes, got over 200. I think I'm closing in on 300 videos now on YouTube, obviously all free. So check that out. I love to help people out. Oh, here's our important legal disclaimer. I know this is exactly the only reason you probably came was for this disclaimer, but I'm going to just kind of go through it quickly. But I do encourage you to please read it because, it's interesting. Most traders tend to not read these disclaimers, but it's really the cornerstone of your education. Don't think of it as just legalese because it's not. Think of it as, oh, this is the regulators sharing with me how to stay rooted and grounded in the realities of trading and avoid hype and have realistic expectations. So this should really be the foundation of your education. Okay, so as I said, today we're going to talk about how to read pure price action. And so we're going to start at the beginning with some basic stuff, 101 stuff, but then we're going to get into advanced stuff. So I've got something for everybody here in the next 25 minutes. And what I want to do is I want to have some interaction. All right, so close down TikTok. All right, and I would love to do a few quizzes with you to help guide you to the truth, to kind of use the Socratic method, if you will, to help you self-discover the answers for yourself. Because if I just tell you stuff, then, you might be right, might be wrong. People tell us stuff all the time. But if you self-discover the truth, then you'll know it's true and you'll remember it. All right. So I will start out with a few things that I'll present here, which I think hopefully we can all agree upon. So when it comes to candlestick bars, I'm not going to go through all the traditional Japanese candlestick patterns. I'm just going to cover a couple of, well, as Ken said, logical takeaways. All right. How to read them logically. So one bar price logic, we'll start with that. So a bullish candle is one that has a wide range, and there's two qualifications: wide range from low to high. So that rules out any narrow range bar. All right, so a bullish bar would then also have a close near the low, and most importantly, an open near the low and a close near the high. That means during this price, or this time, whatever it is, after all was said and done, the market decided, yep, our sentiment is bullish for this period of time. All right, and for a bearish one bar logic, same thing, except the opposite. Again, wide range bar from high to low. That's always the first thing we look at. Is it a wide range bar? Did the price travel a lot during that period? And then it closes near the low. All right, so after all is said and done, market closes near the low, sentiment is bearish. All right, now here's another type of bar. These are my two favorite kind of bars. So here's the other one. Again, wide range bar from low to high. And again, it closes near the low. Now, notice we've got a green real body. I intentionally made it a green real body. This is a bearish bar, but we as human beings, assuming we're all human here, we have this thing in our head where green is bullish and red is bearish. And I want to overcome that. Some people, for that reason, will not color their real bodies green and red. Instead, they will do them where they're solid, if it's bearish, and hollow real bodies if they're bullish. And not a bad idea, by the way. Not a bad idea. Overcomes that predisposition of the bias of the colors. But anyway, the point is that even though we closed above the open, we still close near the low of the bar. And that's what really matters. And what is happening here, to use market profile terminology, this long wick up here, this represents a rejection of value. So the market during this period of time, whatever it was, whether it's a day or a minute, during this period of time, all these prices were traded. But after all was said and done, the market participants decided, nah, we're not going to pay these hard prices. Okay, we've decided that the market's just worth this lower, like the bottom third of the bar. So it's bearish. And the opposite would be the same thing. Again, I used a red candle intentionally here because our bias would be, oh, that's probably bearish, but nope, it's actually bullish because again, we closed in the top third of the bar and the rejection of value is represented by this wick down here. So all these prices were tried. And then when all was said and done, let's say at the end of the day, if it's a daily bar, the market participants decided, no, we can't, no, we like it up here. We're bullish. Okay, now let's go to 2-bar logic. So we're just doing building blocks, right? We got 1 bar, now we go to 2 bars. So this bar negates or invalidates that bar. The green bar invalidates the red bar. So we had a bearish bar, and then the very next bar is bullish, and that's how quick things can turn around. All right, same thing here. It was bullish, next bar, bearish. And this may very well be a cycle high or swing high. 2-bar logic here again. Let's take our example with the long wick. Bullish bar, followed by bearish bar. So the market continued to try to go up, tested these prices way up here, and rejected those prices and said, no, we're not going to pay those high prices, too high. And so market's going to come down. And here's an example that's bullish. Again, bullish bar followed by a bearish bar again. So the market was going down and it still traded to these levels, but there was more demand that came in and boom, came back up. And now all of a sudden people got motivated. They said, oh, this is cheap. This is a deal. No, this is a steal. And we want to come in and this market's going to go up. Now, narrow range bars. So what's the 2-bar logic of this pattern? Well, we have a bullish bar, and that's followed by a narrow range bar. Again, I don't give a mouse's left patootie. That is green, could be red, or it could be a doji. Point is, from the high to the low, it is a narrow range bar. Therefore, it's neutral. There's not enough information there, not enough variable price differential to establish beyond the regular noise of the market whether it's bullish or bearish. So it's neutral. So what's happening here is we just retain the sentiment of the previous bar, which was bullish. And as we go into the next bar, which is neutral, we say, okay, the market is still bullish. Nothing's changed. So it retains the sentiment of the previous bar. All right, I said we we're going to do some quizzes. So now is the time. Close down TikTok. All right, and here we go. So my friends, you're on the spot. As price comes down here, we're going to look at these where we have these magenta arrows right there. Here's the question. Did this bar validate that bar, invalidate the price action of that bar, or what? What is your read on this? Okay, go ahead and type that into the chat box. And let's see, Ari. Oh, I love Ari. First one. You get the first prize for being first. My main man, Tony. All right. Mura. Oh, good, good, good. All right, interesting. We got some smart people here. I love smart people. Kenneth. Stan. Romaldo. hopefully I'm pronouncing names correctly. If I'm not, I apologize in advance. Jit Tamunoibu. Boy, I feel bad about mispronouncing names. Please, I apologize for that. Ama, awesome. Vladin, nice. By the way, everybody who responds, you get 1,000 Top Dog Trading admiration points here just for participation. All right, just for participation. So, by the way, Top Dog Trading admiration points aren't really worth anything. It just means I'm calling out your name so you get the admiration of all the other people here. Right now, if you take it to Starbucks, 1,000 Top Dog Trading admiration points and a $10 bill will get you a homeopathic amount of caffeine at Starbucks. So, but you get the admiration. It's your 15 minutes of fame. Steve's here. Awesome. Wendy, thank you. Okay, so the correct answer is, oh, that's good, Tony. Good. You guys are pretty smart. You get some good comments there. So this bar right here does neither. It is because it is a narrow range bar and it's basically inside of this one. But the key is the very first thing that tells you it doesn't do either. It doesn't validate or invalidate the previous bars is that it's narrow range from high to low. So we can stop right there. Remember, we got two qualifications, high to low and where the bar closes. This one, narrow range bar, therefore it means, well, nothing. Okay, now I kind of set you up for maybe tricking you a little bit, but I'm doing that for your benefit. So what I did was I purposely allowed you to see where the market went from here. And that taps into the brain's forward-looking bias. Because what people tend to do is when they see what happens, they tend to look for ways to explain why, in this case, the market went up. And so the mental tendency would be to say, oh, it invalidates the move down, and that's why it went up. But it didn't. Okay, the market went up, yes, but it wasn't because of this bar. Now this one, yes, we do get a good, better signal here. So the key is on this, there's kind of a lesson inside the lesson here. Be careful when you look at historical charts. And also, actually, here's the bigger tip, is don't think that every move in the market, such as this, is preceded by a high probability trade setup. And a lot of people do this, and the way that it sounds is something like, gosh, the market made a big move up. How could I have known? How could I have gotten into that? And you try to reverse engineer. And there's, in fact, I'll even say this, most of the time, most of the movements in the market are not preceded by a high probability trade setup. There was no way to know you should have been into that trade, and therefore you shouldn't have been into the trade. And just because the market moved up doesn't mean you should have gotten in, because we're trading statistics, we're trading probabilities, and we're not trading certainties. We don't know what the market's going to do most of the time. Well, we never know what it's going to do. We're just trading probabilities. Okay, so very, very important point. The market's going to do all kinds of stuff, and don't feel bad about, not getting into a move, because the only thing that matters is not whether the market moved or not, but whether there was a high probability trade to be had before that move, or at the bottom or at the beginning of that move. And again, most of the time, there is not. And that's okay. And that's why patience is the #1 characteristic of a professional trader. Now here we have an engulfing bar. So yes, this bar invalidated that one. Here, neutral. Here, this bar invalidated that one. Okay, so what about this? Let's do another quick quiz here. So now I'm not gonna give you the benefit of the hard rate edge of the future now. Now you're gonna have to give me an answer on the hard rate edge of the screen. Okay, so I can't use your future forward-looking bias. So what about here? I'm not gonna say much except, what do you think, based on this, what would you expect the market to do from here? That's funny, Wendy. I like that. Okay, so Tony, very good. Ari, good. Kenneth, that's honest. All right. More top dog trading admiration points flying out to everybody here. Vladin, good comment. Matt, good. Thank you, Don. Mura, wow. Ratnesh, Wendy, Jit, James, awesome, awesome, awesome. Romualdo Santnesh. Okay, well, let's see what happens. All right, now, so the market went up, and the question is, was there any way, was there a high probability setup there, right? So actually there was. So what happened, of course, as several of you noted, there was a gap down, correct. And then on this bar, the one that we had at the hard red edge of the screen, first of all, wide range bar. There's a lot of action going on there. Rejection of value at the bottom of it because it closed in the top third of the bar. Now, if you look, where did it go down to test? It tested this low. So it actually rejected that low and then closed the gap. So you put that all together, just because there's a gap, that doesn't mean the gap's going to close right now. But when you see that it tested the low of the day and it rejected the low of the day, that's what gives us a high probability that, yep, the gap probably will close. All right, now this one, okay, goes down. And again, I think you guys all get the idea here. But now we're adding something, and we're adding another tool, which is resistance. So the market went up to resistance. So an issue with resistance, and then we get the invalidation bar, invalidating the green move up, is that it doesn't have to go to the very tip top of the previous high. Doesn't even have to quite get up to the real bodies. Support resistance levels are zones. The market is not so precise that it's going to go to the exact high of the pixel of the bar on your monitor, because we got people trading all over the world, trading different time frames, all kinds of stuff, different data speeds, and therefore support resistance levels. Don't think of them as lines, even though we draw them as lines. Just in your mind, think of those lines as zones, and therefore they are not super precise, and you got to look for a shift of supply demand at those levels. Okay, so if we look at this one, all right, we got a nice wide range bar. I think we can all see that. But when we go into the future, we see that, oh, it sliced through resistance here, closed above resistance. Whereas on this downside, we got a wide range bar, but it closed right at support. And so that's another thing we add. So we've got price bars, we got different formation of price bars. Now we're adding support resistance to help determine when or if price will break through the support resistance. Now we're going to finish up talking about volume, adding volume to the price. Price and volume are very, very important to read together. So we want large volume versus small volume. We want to look at that. Okay, but you want enough volume, but not too much volume, because too much volume could be an exhaustion pattern. But we don't just want a lot of volume. What we really want is smart volume. And smart volume means professional participation. And that means we're going to compare what the professionals are doing versus what the retail traders are doing. Okay, nothing against retail traders. Well, probably all of us here are retail traders, but amateur traders, let's put it that way. And again, nothing bad with amateur traders either. We all started out as amateurs, and hopefully we grow into professionals. So I'm going to share with you a little, it's not really a trick, but it's an inside look that a lot of people never see. So what we're going to do is we're going to bring up the window called time and sales. Sometimes it's called TNS. All right, we got TradeStation. I'll show it to you on NinjaTrader. You have to contact your trading platform to see if they offer time and sales. Most do, but not all of them. So in this column right here, what it does is it gives you a running, so in these rows, it gives you a running ticker of every single trade that goes through the market. So each row is one trade. One trade. And by the way, I uncheck bid and ask in the settings because I only want to see actual trades that go through the market. Okay, you can do bid and ask too for a different technique, but for this technique I'm going to share with you right now, we're looking for actual trades. So going to show me every trade. Now remember, this is different than a level 1 or level 2 or level 3, where it can show you groups of trades in each row. No, this one, each one is a single person's trade or single executed trade. All right. So, oops, went too fast. All right, now the key here is size. So we've got the NASDAQ 100 futures contract. And what I did is I went in, and again in the settings, I filtered it to show me only single trades that have 20 contracts or more. So why am I doing that? Because amateur traders generally do not have big trading accounts. Now, sometimes they do, so be aware of that, because you can have really rich people who come into trading and trade with big money when they shouldn't, just because, well, they got a lot of money from somewhere else. But in general, most amateur traders have small trading accounts, or they're smart and they start trading with little money. And so they're trading with 1 contract, 2 contract, 3 contracts, maybe 4, probably not even that much. So I'm going to filter all those out. I don't want to see the amateur traders. I just want to see the professional traders. And I do that by saying, okay, window, only show me trades where 1 execution was 20 contracts or more. All right. By the way, a little bonus tip here. Some trading platforms have block trade indicators, and most of them don't, but just for those who do, these are really awesome in that it'll take that's what these are called, block trades, by the way, large sized orders, and it'll plot them right under the bars that had those block trades. And this is awesome because it ties it right onto the chart. Okay, now let's look at this. This is the key. This is my technique. And I'm going to ask you a question here in a minute. So my technique is to use 2 time and sales windows. In this one, I actually set it up so that it'll show me only trades that have 1 or 2 contracts, no more than 2. This is my amateur window. This one, let's see, I set it up this time where it has 10 contracts or more. Okay, but no less. And you see most of these are green and these are all red. So let me ask you a question without even teaching you anything. Go ahead and type in. Seeing what you see here, and by the way, notice too, they're the same prices, 1205.75, 1205.75, pretty much down the list, right? 1205.75. So seeing this, would you rather buy at this snapshot in time, or would you rather sell at this snapshot in time? Yep. Good, Tony, Ari, Don, Jit, Kenneth, Stan, Vladin, Matt. Pretty instinctual, isn't it? Pretty intuitive. I didn't even have to teach you. You got it. Right? And that's awesome. And that's 100% right. I'd rather buy too. Because the people of the big trading accounts, they're the professional traders. And professional traders, while they don't always win, they win more than they lose. And amateurs lose more than they win. So we're going to put our odds, we're going to put the odds on our side if we trade with the pros. I call hooking your wagon to the whales. I take my money, put it in my little red wagon, tie one end of the rope to the handle of my wagon, tie the other end of the rope to the whales, the tail of the whale, and I just trade with them, let them take my money and go. Okay. There's a couple of other nuances here. We're running out of time, so we don't have too much time about it, but in NinjaTrader, this one's NinjaTrader now, you can also, they also have a variable where you can color it differently. If there's a buy above the ask, that shows a very aggressive buy, or a different color, I made mine magenta, if you sell below the bid, very, very aggressive. And then they also give you another column. So if you notice, this is, it's mixed, right? Red, green, red, green, red, green, a little more red than green. I've got it 20 contracts is the minimum. But now I've got this column over here, and this column I set to 50 contracts or more. Now we're looking for the really big money. And if it's 50 contracts or more, this word block pops up. And every single one of these that is 50 contracts or more are red. And so now we're at another level, yet another level of professionalism. Okay, this can really help you if you're a breakout trader, by the way. Look at how we're consolidating. And now, okay, market breaks out. Our big question always is, well, is this going to really be a breakout or is it going to be a fake out? Will it follow through or will it fail and come back into the channel? So I love to put my block trade indicator on here. And if I see it breaks out on professional trading, then I'm going to go ahead and take that puppy and I can trade that like breakout with confidence. So there you go, my friends. Hope you found that helpful. What I have for you, I don't have anything to buy. You can't buy anything from me today. I actually forbid you from buying anything from me today. But what I will do is I'll give you one of my free mini courses. How's that? And what this mini course gives you is very practical. In fact, the mini course comes with an actual trade strategy that you can take, use, start making some money for free. And if you like it, make money, hey, make some money and then use that money to maybe buy my more advanced courses if you want to, or go to Starbucks and cash in those Top Dog Trading admiration points, whatever you want to do with it. Okay, so it comes with one of my favorite trade strategies, rubber band trade. 5 days of video instruction, got quizzes, just like today. You know me, I like to do quizzes. I share with you my cycle indicator. This is on a separate recorded webinar, but that's free too. And you can get it all for free by just going to topdogtrading.com/free. And that's it. You just go there, sign in, and you get all them goodies. And so I'm going to type that in here to the chat box. And over and out. Thank you, Ken.
Well, thank you so much, Barry. It was brilliant. I like the idea of filtering the volume on the tape. I've been using tape reading for 20 years, and that's a new one to me. So very smart. I highly recommend Barry Burns. He knows his stuff. He's one of the good guys out there who actually has worthwhile information for people to learn. So very well thought out and very entertaining and engaging to watch as well. So great job, Barry. I'm clapping out loud. You did a good job, man. Thanks.
Thank you very much.
I'm a fan. You're good. You know your stuff. So thanks for being here. Appreciate it.
My pleasure. Thanks for the invitation.
All right. Well, traders, next up we've got Steve Nissen. Steve, are you out there?
I am here.
All right. Well, it's my honor to present Steve Nissen. I've worked with Steve for 20 years, and let me make you the host. A quick administrative note. Steve, I'm going to make you the host at the end. Please don't sign out until I reclaim the host so it doesn't end the webinar for everyone, okay?
Okay.
And let's see. Let me...
I got to figure out. Okay. So
Let me make you the.
Okay.
I have to make you the host, I believe. So let me do that. Change host to Steve Nissen. Yes. And you should be able to share your screen, and you
Okay.
should
So
be
let's do
good to
share
go.
screen. Okay. And okay. So let me see if this works here. Click share here.
Right, the green share screen icon at the bottom.
Oops. Okay. Can you see it?
Not yet. You're the host, so you can do it.
Okay. Let me.
Click on where it says share screen at the bottom, the green icon, and then it will ask you which of your screens, if you have multiple monitors, you want to share, and then click the share.
Try this again. Okay, so bottom right, share. Okay, so it's on.
And now it says you start, and you're good to go.
Okay, so
now we have your desktop here.
Right. Good.
And there we go. All right.
Okay, great.
All right, now traders, I just wanted to, all of you here, it's my honor to have worked with Steve for 20 years. I use what I've learned from Steve every single day. I do as many as 80, 90 round-trip day trades in stocks and ETFs daily, and what Steve teaches works. I've been using it for decades. Very helpful. Steve Nissen is the #1 and world's top industry expert on candlestick charts. He's the only person I believe you should learn candlesticks from. Steve Nissen's one of the world's top experts, and from candlecharts.com. Great to see you, Steve Nissen, and take it away.
Great. Thanks, Ken. Always great joining you. And the aspect of this short session is actually related to what Ken just said, making sure you use candlesticks correctly. So before we begin, just do the risk disclosure. obviously you don't have to read this, but just remind you that you can have risk of loss of trading pretty much in any market in any time frame. I'm sure many of you are familiar with the candlesticks, but for those who are not, just want to go over why candlesticks are the go-to charting method since I revealed them back in the late 1980s. It's hard to imagine that before my first book came out, that all the charts in the Western world were made with bar charts. Can't even look at a bar chart now. There's so little information. So candlestick charts are very easy to understand. I'm not going to go through the basics. My assumption is you know what a candlestick line is and what a green and red real body is. They allow you to do what we call safety first trading, know what trades to avoid, just as important as knowing what trades or investments to get into, because at the end of the day, it's not how much you make, but how much you lose. One of the things that I'm real excited about, and the reason I'm glad to join Ken today, is everything you're learning beside my sessions and learning how to use Western technical tools, everything you're learning with options and Forex and Western technical techniques and whatever it is you can combine with candles. So I'm going to show you the power, the importance of combining EAST, that is candlesticks, with Western charting techniques. Candlesticks work in all markets and all time frames. Here at candlecharts.com, we have students from over 85 countries around the world. My books have been translated into at least 20 languages and still counting. And candles are great for early reversals, letting you know when the market's going to potentially reverse. So as I mentioned, the goal of this session is letting you know when candles, let me do it this way so it's better, to correctly use candlestick charts. And I have this here. And the actual real sad part is these are my parents. So we won't go into that. So we're going to help you avoid feeling like this by showing you 3 main misuses of candlesticks. All right. So the first one is not using Western technical indicators. Next is not understanding candles in context. And we're going to go through each of these individually, so don't worry about that. And the third one is not looking at risk reward. So let's look at the first indicator or first mistake, not using Western indicators. Now, we should all know that a candlestick line is made of an open, high, low, and close, right? If the close is higher than the open, you have a green or empty real body. If the close is under the open, you have a red or a black real body, depending on your charting service. So open, high, low, and close, that's exactly what you need to make a bar chart. So most all Western technical indicators are decades old, and they're based on bar charts, moving averages, trend lines, Fibonacci retracements. So whatever you do with a bar chart, whatever your favorite Western technical tools are now, I strongly suggest adding them to candlestick signals. And I'm going to show examples of how I do that. So let's look at mistake number 1, not using Western indicators. When we have a candlestick signal confirming a Western indicator, we call that the multiply effect, because we're having 2 signals confirming each other. Here's my work desk when I was translating these are all Japanese books. These are only some of them that I had translated. It took many, many years and many tens of thousands of dollars to pay somebody to translate all these books. And this actually are the English translations. This binder here are the English translations of these books. But the reason I wanted to show you this is because pretty much in all the Japanese books, they also incorporated Western technical indicators. In fact, here's a cover of one of the books. And since I don't speak Japanese, I wrote the name of the book here. And this was reference number 8, book number 8. So I was able to know which book I was talking about when I was doing the translations, or not me doing the translations, but doing the signals, the candlestick signals. But notice even on the cover, he had a couple of, I'm assuming it's a he, couple of moving averages in addition to candlesticks. By the way, when a faster moving average like this one crosses under a slower moving average, the Japanese call that a dead cross. If it crosses above the moving average, it's called a golden cross, just FYI. So what the Japanese have been doing for generations is using our what we use in the West, moving averages, trend lines, etc., and adding the candlestick signals to it. So let me show you some examples of how this works. So let's say you like using overbought, oversold indicators like RSI. So here we have a couple of doji, right? A doji is when the opening and closing are the same. And normally a doji is a sign that the market is turning from up to neutral. It doesn't mean it's turning from up to down. It's just more of an equilibrium between the bulls and the bears. That's why the open and closing are the same. It doesn't mean the market's going to go down, but it increases the likelihood. You can see here, the bulls are very much in charge, white real bodies. Depending on your charting system, these could be green. So here we have a couple of doji. And by the way, the plural of doji are doji, my translator tells me. But let's look at this in combination with RSI. Okay, which of these doji are showing the market's overbought? Okay, this one. So this one is more likely a reversal than the first one. By the way, getting a little bit more advanced here, although there was a doji in both cases here, because these were new high closes, although the higher odds are here that the market's going to turn because of overbought levels, I would still wait for a lower close because, yes, it's a doji, but it's a new high close for the move. And this is an example of what I call candles in context, which we'll look at some examples in a couple of minutes. So here's one way to use candles and Western technical indicators. Here in Bitcoin, okay, recently, okay, we have, this is called a piercing pattern. It doesn't matter if you know the name or not, but one of the things I really like looking at is if a candlestick signal confirms a Western indicator. So one of the ones I like looking at is prior lows and prior highs. So here, a support area. A lot of the candlestick signals can be used as support or resistance. So here's a support area. The market confirms support over here. This happens to be a daily chart. And notice over here, many of you will recognize this as a bullish engulfing pattern. And this takes on more importance because it's confirming a prior low. Now, this happened to be a candlestick signal, which is very common at bottoms and tops. You get a candlestick signal as an early reversal. That's why it's so great for option trading also, because most of the move in options, most of the premium is based on trend. Yes, implied volatility is important, but far and away the most important aspect is trend. And if you can call the correct trend, it really helps with your option trading. So even if this was not a candlestick signal, if these were lows here, okay, the fact that the market made a bullish engulfing pattern, and this is a classic one where we have a green, a long real body compared to a small red real body. So here we have a candlestick signal confirming a Western signal. Your Western signal might be a moving average or a trend line, an angled trend line. I like looking at highs and lows. The recent highs here, this happens to be a bullish engulfing pattern in early October. Okay, and again, as I mentioned, many candlestick signals can be used as support or resistance. But even if, there's a bearish engulfing pattern, and even if this wasn't a bearish engulfing pattern, it would be a potential resistance area. And lo and behold, look what the market formed there, a doji. Here again, although it's confirming a resistance area because this is a new high close for the move, I'd wait for a lower close. So this happened to be, these three candles happen to be an evening star. But the doji here confirming resistance, if you happen to be long, here's another bullish engulfing pattern. If you happen to be long from here, okay, this would be a sign to liquidate on longs. One of the things when we talk about bearish candlestick signals, not necessarily using it to go short, a little challenging to do in outright. It's great to do with options and Forex, but also knowing when to exit long positions. So I'd be lightening up on long positions here, and I'd be out of all long positions here because you're getting bearish confirmation. But essentially, nice examples of how we have a candlestick signal confirming a support area, horizontal support, and candlestick signal confirming horizontal resistance. This is what I mean by east and west. A little while ago, we got an email, and somebody recognized this as a shooting star, and the market rallied a little bit. Okay, there's a low price stock, and he said to us, "Oh, the market rallied after the shooting star. The candles don't work." Of course, candles are not 100%. Okay, the Japanese say even monkeys fall from trees. But we got back to him and we said that this is actually a great time to add to your short position. Why? Look at what the shooting star is confirming. Now, whenever you do a trade based on a candlestick signal, you must be willing to risk to the high of this case of the bearish engulfing pattern. So if you shorted here around 13 3/4, I still talk in fractions, 13 3/4, you must be willing to risk above 14 1/4. So the market rallied. Did it get to a stop out level? No. And the fact that the shooting star was confirming resistance area greatly enhanced the likelihood of the market reversing. And this is what happened after. Okay, of course, if the market got above 14 1/4, you would have been out of your short position. So nice examples of combining candles with Western technical indicators. There's a wonderful, here's another example. Okay, here's a trade I did. And by the way, a lot of these I took off the markets and the time, because candles are universal. And it doesn't matter what market you trade or what time frame you trade in. So I wanted to show just a broad application of candles. So here the market had a hammer. Market sold off here. No bottom reversal signals yet. On this session is when I bought, and my target was the most recent high. Okay, so this is actually a really good risk reward. So here we had a couple of days, a couple of sessions where the candles confirmed a support area. Now, normally I'd place a stop under the hammer. Okay. But where do you think I had the stop? Would it be under the hammer at 61.5? No, I had it under here. Because let's say the market sold off after I bought it and it got to 61 1/4. Yes, it would be under the hammer, but this low here would be holding over here. By the way, we're going to look at this later. There's a rising window, a gap, and gaps become support based on the close. It's one of the reasons the market rallied there. So just to show you ways that I actually apply Western technicals with candles, even if this one was not a hammer, the low here and the low here gave me a support area. So there's a wonderful Japanese proverb that says, look on the outside to know the inside. And what we could do is, and I have some trading principles that we could use the candle line to show not only the price, which, obviously it'll do like a bar chart, but the real power of candlesticks is it shows the force behind the move. So let's just go back here. So let's think about why these candlestick signals show what's happening. Long lower shadows. So what happened, 61, 61.5, the fact that the market sold off here and then rallied to here showed that the market was showing strong demand and closed near the highs. So within one candlestick signal, we got a sense that the prior trend, long black real bodies, was changing. Okay, same thing over here, a doji telling us that the market is going from up to a point more of indecision. Okay, so let's see how we could use that. Okay, so what we could do is analyze the candle line at support or resistance. And we saw that before when we saw a bullish engulfing pattern in Bitcoin at a support area and so forth. So here, just to give us another market, because all these work in all time frames, here we have a bullish engulfing pattern, okay, right at a support area, okay? Okay, no bottom reversal signals here. Candles are not going to give us a reversal every time, but here the market made a low. Not much you could do here. I wouldn't be buying it, but notice over a period, this happens to be a daily chart, the market stabilized here. So now we had a support area around 129.60, 129.50 in the Canadian US. And now we have a bullish engulfing pattern confirming the support area with a candle signal. If we bought, okay, actually my target would be up here with these two doji. Okay, I would have probably been out here. I didn't do this trade. Over here, we have services where we give you strategies and so forth. So over here, with the shooting star at resistance, I would have taken profits. But what's nice about this, a good risk reward, and we'll talk about the importance of risk reward. If you buy it here, your stop is under here, your target is up here. So multiple times price target of your support, then your support area, hence a really good risk reward strategy. Okay. Here again, another Forex, but markets, these work in all markets and all time frames. So here the market had a resistance area, the doji confirming resistance, and then if you needed more information or more confirmation, the bearish engulfing pattern. So what's nice about Forex is it's just as easy to short as it is to go long. But if you happen to be long on this market, the Forex market, I would probably lighten up over here, but definitely over here. The reason is that there's actually a bearish Harami, not as negative as it would be with a bearish engulfing pattern, but perfect opportunity to think about shorting with a very tight stop. Okay. And there you have that. Okay, here the market is in a downtrend. Okay, and we're going to analyze the candle signal at support or resistance. So here there's a support zone. Okay, 1, 2, 3 sessions. This happens to be a bullish engulfing pattern. And notice what was happening to the real bodies as the market was selling off. They were getting smaller and smaller. Nothing really bullish here yet, but the diminishing size of the real bodies, as opposed to these long red real bodies where the market opened here, closed here, opened here, closed here, strong downside momentum. The bearish momentum was running out of steam. Not quite enough to be bullish yet, but at least confirming a support area. Here's where you get the bullish signal. You get a hammer where the market actually closed in the high at a bullish engulfing, at a key support level. Okay. Now, one of the things with the candles is you can't forecast a price move. So here's this guy saying, I can't tell you how far it is, but I do know it's that way. And candles are stellar for giving you direction. Again, that's another big plus, not only for outright trading, but if you're doing option trading. So here, for example, we have a classic Western signal, a congestion band. The Japanese call it a box range. And in Western technicals, we take the box range, and I went from, here's the zone here, the box range, lateral trading environment is when you have support tested at least twice, 1, 2, actually 3 times, and resistance tested at least twice. So 1, 2, 3, 4, 5, 6. So when market's in the box range, we actually had a hammer. I love box ranges, a hammer testing the bottom end of the box range. So the target would be the top end of the box range where the market got to. But with Western technicals, we need to use Western technicals to get price targets. All right. So I'll use swing targets and box range breakouts. And just to refresh your memory, a box range breakout, whichever way it breaks out, you take the height of the box range, and if it breaks out to the upside, you add it to the resistance area. If it breaks down to the downside, you subtract it from the support area. So from about 1150, let's say $200, 1150 to 1350, the market broke above this resistance area. Whoops. And as soon as it did that on this session here, 1350, we had 200 to 1350 to get a target to 1550. Now, most often the target is not a resistance area, but in this case, it happened to stall there. So one would think about taking profits. But this is a great way, again, of not only using Western technicals to confirm support or resistance with a candle signal, but to use Western technicals to get price targets. And one of my favorite, I don't have it here, but just as long as I have it, one of my favorite strategies is what I call change of polarity. Once the market breaks a resistance area, so if you could mentally extend this line, old resistance on any pullback should be support. So once it got above 1375, by buying it here, you should have a stop under 13, say 50, because this old resistance should be support. And that worked out very nicely. Okay, let's look at mistake number 2. Okay, not understanding candles in context. We get so excited when we recognize a candlestick signal. We should always think of not using them in isolation. We have to look at the overall technical picture. So here we have a doji, but not all doji are the same. Okay, here are the markets in the box range. Here's a doji in the middle of the box range. The doji is reflecting the markets in neutral. So is the box range. So I wouldn't pay much attention to this. If we get a doji at the top end of a box range, that's a whole different scenario, because now, based on East and West, we have a Western signal. Here we have a doji. That doji I would pay much more attention to, with the idea that maybe the market is stalling here and the market's going to return to the bottom end of the box range. So 2 doji, trade them completely differently. And that's what ongoing education is all about. I'll tell you how you can continue your education beyond the basics of what I'm doing here in a little bit. Now here, the Japanese have what they call a rising window. It's a gap higher. And a rising window is a support zone. Okay, it's a gap between the prior session's high and the current session's low. The market could, as the Japanese would say, momentarily get under the window. What they mean by that is that it can move under the window inter-session as long as it doesn't close below the bottom of the window. That window is still a support area. So let's look at this. Here we have a gravestone doji, okay, where the low and open and close is near the low. It sounds really ominous. Essentially, it's a doji, but let's look at candles in context. There's a gravestone doji, but where's first support? If you're bearish here, where's first support? Right, the rising window. So at a minimum, I would wait for the market in this case to close under 30.5. So you have a whole series of doji here. Normally it's a warning signal, but this is a bullish breakout, a support area. So one would not be bearish on this doji unless the market confirmed it by a close under 30.5. Okay, same thing here. Shooting star over here. Long upper shadow candle, small real body at the bottom end of the trading range. But what would we need for some confirmation? A close under the rising window. Okay, this was a few weeks ago in the Dow. So this was the bearish confirmation. You actually had two things going on. Shooting star, three things. Bearish engulfing pattern and a close under the rising window. So yes, we'd see a shooting star, but this is a great way of seeing the importance of education, knowing yes, it's a shooting star, but there's also a rising window. Same thing here, a hammer, but a falling window. To know where you stand is as important as a candle pattern recognition from one of my Japanese books that I had translated. It's one of the quotes. So in this case, it's a hammer, but we need to wait for a close above the falling window, which is a resistance area, which did not unfold. Okay. Okay. Which is a better signal to sell? A bearish engulfing pattern or a shooting star? Well, we normally think here, but let's look at this from a risk reward perspective. Okay, here's the bearish engulfing pattern. Look, by the time you got the signal. So your risk is here and your target is here. Here we have a shooting star. It's also a doji. Your risk is up here and your target is down right around over here. Much better signal. So always look at candles in context. And this leads me into the last topic, probably one of the most important, not looking at risk reward. Okay. A candle signal, even if it confirms other indicators, Western indicators, is not enough of a reason for a trade or an investment. You must always consider risk reward. Write this down. Okay, this is a core concept. Most traders get this wrong. So reward equals profit potential, risk equals potential loss. So here the market closed above a falling window, right? Okay, do we buy it? Well, we ask our question, what's the risk? What's the target? If we buy it here, my target, your target might be different, is up here. Okay, so we're looking at maybe $5. What's the risk? The risk is all the way down to here, the bottom of the hammer, okay, which is about $4. So to me, this would not be a good risk reward. I would step away from this trade. Okay, same thing here. The market has a resistance area here, doji. Here the market closed over resistance, okay? But do you buy it? No, because then you have this as resistance. So yes, it broke above here, but this is not a good buying opportunity. Concept here, candles in context is a hammer. Would you buy it here? No, because remember we're talking about change of polarity, prior support becomes resistance. That's exactly what happened here. So we always have to look at candles in context. And final slide before I wrap it up. Okay, one of our students, Gary, said he bought at this bullish engulfing pattern. And the reasons were it broke above a falling resistance line and it broke above a moving average. And he wanted to know was it a good trade or it just didn't work out. And some of the trades are going to work out. Okay, it held a support area, but think about this from a risk reward. That's the one thing he did wrong. He was right on the breakout. He was right above a bullish engulfing pattern. He was right at held support. But from a risk reward, you're buying it here. Your stop is down here. Okay. My target would be up here. this is a 1-to-1 risk reward. Although he had the candlestick signal confirming a support area and breaking above resistance, this is a trade Gary should have stepped away from because of the poor risk reward. Always, always remember risk reward. So, okay. In conclusion, and there's that risk reward. You can see the risk was actually higher than the potential reward. So let me give you our special discount here. We have, this is great for beginners or for those intermediate and beyond. 2 express class options. They're not on options, but these are 2 candlestick courses for you. They're each 3.5 hours. You get all printable handouts. And this is a great way to streamline your education. You get a bonus quiz to ensure you understand the material. Everything, like I did today, is true here. Works with all markets and all time frames. By using the discount Achieve, you're going to be getting a 10% discount. It's going to be ending very soon. Go to candlecharts.com/bundle. And these are just some of the things you're going to get on here. My most important candlestick signals, my 360-degree candle analysis method. You can't get that anywhere else. Valuable bonuses. And it's a great way to continue your education at a great price. So over to you, Ken, and thank you so much for inviting me.
Well, thanks so much, Steve Nissen. It's been a pleasure. Really smart things. I've used what I've learned from Steve for over 2 decades now, and it works. The main benefit is learning things like risk reward and the decision making, the decision support beyond just simple candle patterns. It's the rest of it that makes a big difference. And you did a really good job of covering that. So thanks so much. Good to have you here.
Thank you, Ken. Always great working with you.
You too.
Thanks everyone for joining us.
All right. Well, next up, we've got Harry Boxer from thetechtrader.com. Harry, are you out there? Let me...
So do I just do stop share, Ken?
Yeah, let me get Harry online here.
Okay.
And we should be good to go. All right. Just a minute here. All right. Let me ask Harry to unmute.
Can you hear
All
me
right.
now? Yes.
Hey, Harry. Yeah, I hear you. Okay, let me promote you to the... or actually, let me promote you to host, and you'll be good to go. At the end of your presentation, do me a favor and hang on for a few minutes because I need to reclaim the host so it doesn't shut it down for everybody. But
Okay, before we go on, I want to make sure that we're on the right screen. Are you seeing my trading room?
not yet. Let me promote you to host, and then you'll be able to share. Let's do this right now.
You disabled participant screen share.
Okay, now you should be good. I promoted you to host, so now you're the big boss of the room, and you should be able to click on screen share. And
What do you see now?
yeah, I see the PowerPoint slide, the Tech Trader Real-Time Technical
Okay,
Trading.
see, that's the front page of my website.
Okay. Oh, it's good. It looks good. It's a new look. It looks great. Hey, everybody! I wanted to just take a minute to introduce Harry Boxer from thetechtrader.com. He's absolutely brilliant. He's got especially good techniques for breakouts. His book is Profitable Day in Swing Trading. Outstanding book, and his website and live room at www.thetechtrader.com. Highly recommended. Harry's one of the best guys out there I know in the whole industry. So, Harry Boxer, take it away, and thanks for being here, man.
And thank you, Ken, of course, and thank you, everybody, for being here. Today, we're going to talk about market conditions as they are now. I'm going to show you some trades from Friday to show everybody that we are day traders and swing traders for the most part. It's tough to do swings in this volatile market, but I can tell you that no matter what the market is showing us, we can make trades long and short every day, and I'll show you some of the trades we made Friday. But again, this is the front page of my room. It's called thetechtrader.com, in which we do day and swing trading alerts throughout the session, live intraday webcasts where I come on pre-market several times during the day and even after hours with my people and show them chart and do chart analysis and give them minute-by-minute analysis and updates. It's a live trading room with hundreds of members in it. We have trackable trading lists. I do a nightly video every night. I do a weekend, very comprehensive video of all the indices, the underlying technicals, the NASDAQ 100 generals, some of the ETFs that we follow, such as the semiconductors, the financials, and the biotechs. And I also go over 50 to 100 individual stocks long and quite a few, maybe 3 dozen shorts as well. Today, since we're limited, I just want to log into the room and show you some of the stuff we do, and then you'll get a feel for it. And this is the room where you can see people posting on what's going on in the market. Even now, on Saturday, I come in and I told everybody that the Mcmillan oscillator, I don't know if most of you may not be aware of this, but the close on Friday of minus 213, Ken, was the lowest close in almost 2 years. March 12, 2000 was the lowest close, lower than today's Friday's close of minus 213. Now, anytime you get to minus 160, 180 to 200, it's oversold. Below 200, 220, 240, very oversold. On a couple extremes, we've seen 285 to 300, but for the most part, this is the lowest close in 2 years. One of the reasons why I'm not as pessimistic as everybody is. And not to mention the NASDAQ is now off about 18% for the year already, since the top, excuse me. And so to give some examples of that, let's go into what I use as a market minder and show you the indices as they are right now. As you can see, the NASDAQ 100 has gone from 16,000 in mid-December to 14.4 and about 1,600 points down. And that's almost a 10% slide from there on the NASDAQ 100. The S&Ps have gone from 48, I believe it was 13 or something, to 48.20, down to 40, under 4,400 on the close. And if you project on the 5-minute chart, these are hourly, by the way. If you check the 5-minute charts and the parallel channels and how they're falling, the angle of descent with the close where we are, it calls for a drop down to 43.30, with the NASDAQ 100 dropping down to 14.12 zone. That's very steep. But if you look at the Mcmillan oscillator, you'll see how steep this has come down. And just from the December 28th high of plus 164, which was as overbought as we've gotten since in a year. Not surprised to pull back, but the steepness of the decline just last week alone took it from plus 92 to minus 213 at the close. And although we've gotten down here before, we've never closed there. Look, this bar reversed and this bar reversed. And almost every bar we've seen down in this area showed a spike off that low versus this one who closed there, leading me to think that we're going to go down in this zone, maybe to minus 250 or so before we get a much deeper bounce. So what I'm looking for, and I could be surprised because of the steepness of the oversold condition, we could gap up on Monday. I won't be happy with that. I want to see gap down and then reverse to create more of a throw the baby out with the bathwater type scenario where the VIX spikes into the low 30s and the intraday tick gets to minus 14, 1500, and you get an extreme on all the indicators at one time. That is always the best setup, and I think Ken probably agrees with that when you see streams like that. So that's what I'm seeing here. And also something else that I look at is the percentage of stocks that are above or below their 40-day moving average. Look how rapidly this has dropped from more than half the stocks above their 40 to only 1 out of 5 above their 40. Now, on a couple of occasions in the last couple of years, we got down to 12 to 15% and bounced. At the March low of 2000, it got down literally to 1 to 2% of stocks were above their 40. That's how extreme that sell-off got. If you look back on a weekly chart on that indicator, there has been several occasions in the last 10 years where we got down to single digits. So this could get a lot worse in the next day or two, but I think we're getting very close to what I think a tradable bottom, or at least from an extremely oversold condition, at least a strong technical bounce. And that's what we're always looking for, ideal conditions. And to say the least, the volatility in this market is extreme now. And so we'll have to keep tabs on that. Now, one other thing I look at is where is the VIX? The VIX indicator, which is to me, a fear gauge, which exploded when the market crashed in 2020, we got to plus 85. That's a level that you rarely see. Let me show it to you. In the last 18, 20 years, we've only reached that level twice. Most of the time, the tradable lows, the tradable highs, I should say, came in the high 40s to low 50s. Now, we're only plus 28, 85. But you can see the last couple of days, It's gone 16 to 28, nearly doubling. And there's a range of resistance up in that zone there where I think we could get to early Monday, where this spikes up into the low to mid 30s or more. And that gives us a trading opportunity on the UVXY, which is looking terrible. But take a look at this. The volume on Friday on the upside was the biggest volume ever traded in history on the UVXY in one day. 151 million shares, unheard of even for the VIX, for the UVXY. But you can see how it's broken above the 50. It might lead to a range there or there early on Monday, Tuesday, that creates an extreme where we get into the high teens, low 20s. So with 17 and a half here, it may create a tradable opportunity. Even if it's just the first hour, this thing could spike up 3 or 4 points. So keep an eye on UVXY on Monday. And any of the other instruments, the short instruments. The SPXU is something I follow closely as well. Take a look at this spike. It's gone from 12 to 16. Now that is a big move for that index, which is more of the S&P 500 and not as volatile as the NASDAQ, for example, or the VIX. This is based on the S&P index. One of the most important things to consider, what's the long-term trend? Well, check this out. This is a breakout of a 2-year downtrend, which means it's a possibility that if we spike down in the next day or two, this could reach upwards of 18. May be able to create a quick 1 or 2 day trade and get 2-3 points out of it. But momentum is strong. The thing is, it could reverse quickly. You got to be awfully careful. Do not play these without stops, folks. Protect yourself on all trades. So what I want to show you is some of the things we did on Friday, long and short. I think you'll find it interesting. Now, nat gas, we traded this phenomenally in the May, June, August, September period, when this thing went literally from 17 to 94. Notice this island reversal right there at the top, and more of a head and shoulders as well. We had one more bounce up, and then it rolled over. And to me, this is where the key came in, right in there, where it broke down below the head and shoulder pattern and created some consolidation, which then just fell out of bed. And this went from 56 to 26 in a week and a half. Now, we've recently had a bounce and a pullback, but I think that nat gas wants to go higher, and I'm looking for this one. If it holds the reversal and breaks out again, to make a run into the mid 30s from where it is right now, 28. Keep your eye on the Boyle and the other nat gas ETF, which looks the same as UNG. It's interesting to see the 1, 2, 3, 4, 5 wave decline. Elliott wave it, base pattern breakout, retest. Now we'll see where this goes from here, but it's an easy stop under Thursday's low. Stop under 1270 on that one, and stop on the Boyle under 25.75, something like that. And so, but on Friday alone, I want to show you the intraday day trades that we made on this one. You'll see that it spiked up in the morning, pre-market, and came down. And when it broke out of this little inverse head and shoulders pattern right there, I put a buy on it. And I said, add to it if it holds support and breaks out again. We added there. I had a trading target of 28. It got up to 28.38, pulled back. I had a secondary trading target at 28.75. We reached 28.79 and backed off, and you see the rest of the day. But there were 2 day trades in there. The UNG was the same pattern. It broke out from the wedge. Breakout was right there. The retest came. It was a perfect retest because it did not take out the prior high or the pullback low, and then took off like a rocket, pulled back and ran. It basically had a 1, 2, 3, 4, 5 wave move. Many of us sold it at the 13.25 range that I put out. It reached 13.30, and then it pulled back and spiked up again and eventually reached 13.40. Not that much more. And you can see what it did later on in the day. The UVXY, which I just showed you on Friday, was a perfect trade, and I'll show you why. First of all, early on, when the market opened, it went vertical and backed off, and I said, if the pullback holds here and starts to move, we're going long. So most of us went long around 15.75.80, and within 20, 30 minutes, it was 16.66, about an 80-cent pop, or about 5%. And then it had a perfect 1, 2, 3, 4, 5 wave Elliott wave decline in an orderly channel. And when it broke out, I put a trade on it. It then pulled back, it did a 50% Fibonacci retracement right there, performed a perfect inverse head and shoulders, and broke out. Now, this trade didn't work as well when it broke out because it pulled back and backed and filled, but eventually it did take that support level and ran up again. And notice the rising channel that formed after that. almost perfect. And then blew off. This is where I told everybody to exit the trade on the blow off near 17.25. It actually reached 17.25 to the penny and backed off before making a higher high. That was the UVXY, and the SPXU was similar. These are trades we made on Friday. First, the breakout there, and then the pullback. I instructed them to do a scalp trade if they could. It went from 15.12, wasn't that much, 15.41, about a 28-cent trade, 2%, not a big deal. But then it plunged, and we were stopped out right there under the pullback low, and did a 5-wave Fibonacci, Elliott wave, excuse me, pullback. Falling wedge, break out of the wedge. That's where we put a trade on right there, about 1480. It stair stepped its way higher all day. My target was reached at 1540 and 1575, I believe. It's 1575 at the close, something like that, 1568. Didn't quite get there, but you can see what it did after hours if you held on to it. So those are trades. Look, and when people ask me, what are you trading short? Well, I gave 3 shorts out on Friday, and I'll show you what they were. But I like to buy the ultra shorts long, meaning it's an ultra short instrument that goes up. So we traded the SPXU and we traded the UVXY both successfully as the market came down. But with that nat gas moving up, we traded the UNG long and the Boyle long as well. Yes, there were some stocks that we traded that did well, and here's a couple of them. Gamada, which popped and formed a wedge, then broke out. I put a trade on it right there at about 308. Didn't do much initially. It went up to about 318 and backed off and formed the coil. So you had to be patient, but it did not break support. We had our stop right there in that range, just underneath it, and then it formed the coil and exploded. Finally, if you were patient, my traders, some of which held on to it, went from about 308 to about 338.39. My target was 339.40. We reached 339 exactly on a spike. And I always instruct people, if you're in an afternoon and a stock has a 1, 2, 3, 4, 5th wave up, and it spikes like that on volume, always exit, because everyone else is going to. And then you can see the steep pullback that occurred. MYNZ, really pretty chart. If you take a look at the pattern before today, it was forming a 3-day coil, got narrower and narrower, not breaking support. I told my traders stop under 22. The breakout, after it popped and flagged, when it started to move, we broke, I think it was 24.98 or 25 exactly. We put a trade on, and within 30, 40 minutes, we ran up to 27.71 for almost 3 points, about $2.80. And it hit right on my target at 27.75, I believe. Let's see, 27.71, pretty close. And then pulled back and eventually went even higher. So the last two, GMDA on the long side and MYNZ on the long side, were actual long trades on a day when the market was just horrendous. In addition to that, we traded Peloton, believe it or not. I want to show you the pattern. First of all, the day before yesterday, when it plunged and got to an extreme oversold condition near support, I said, if you start to see a reversal bar go long, we all went long around 24.75. My target was 27. It reached 27.21. So everyone made a $2.25 quick scalp, about 9% trade in literally in minutes before it collapsed. Now on Friday morning, the market, it popped initially to resistance, then came down hard. But when it bounced and pulled back, I said, it looks like a V bottom with a right hand extension or inverse head and shoulders. So I instructed them go long on the breakout above 25.75. Most of my traders went long in this range, and you can see that within 30 minutes, it went to 28.08 from 25.75 for a very quick trade. And I happen to have had a target at 28. So it was very close to the target range. It came down. It formed a little mini inverse head and shoulders or a right-handed extended V, but here was a breakout and the retest and a nice spike up. It did very, very well. So you can see how this here eventually formed the coil. But we were out on this run up. And some people who wanted to go back in may have made some money there, but we didn't. So that's an example of the kind of trades we make at techtrader.com. We look at technicals only. I don't care about fundamentals. If I'm a day trader, the only thing I care about at fundamentals is what the news was before the opening or during the day that triggered the price move. Then I look at the technicals and determine my targets, my stops, etc., where support and resistance might be, and I draw my lines. You'll see a lot of lines on my charts because I'm always drawing in support, resistance, pullbacks, and targets, things of that nature where my traders want to be thinking about exiting the trade. There were 3 specific shorts I put out, and they were intuitive surgical. I said, always, when I see the stock gapping down like this, sell the first bounce when the stock bounces. Well, the market opened here and immediately bounced 3 times, could not get back through resistance at about 280, 82, and just fell apart. Now, this alone from here, literally in minutes, at 9:46, it was trading at 281. At 10:06, about 20 minutes later, 15 minutes later, it was 270, 11 points straight down. And if you were patient, even though it did a 0.618 fib retracement, it then stair-stepped its way lower and eventually reached 267 from my initial 281 entry point, 14-point day trade if you were patient, but it would take a lot of guts to be patient with this move. Now, the only thing about this move up here, that it came on low volume without a real strong increase in technicals, leading me to believe it was going to eventually roll over anyway, and that's what occurred. As bad as Netflix looked pre-market down 100, we still went short on the first bounce. Let me show you something. So it got crushed, rallied back pre-market, and I said to everybody, if the market opens and it bounces, sell it. Well, this was so weak before even the opening that it bounced for 2 minutes. It got up to 405, and within a half an hour, it was 380, 25-point day trade on the short side. I instructed everybody, if you didn't cover or sell when I gave you a target of 380, which by the way was almost exactly, the low was 380.11. That's the breakout. And you can see the spike up to resistance, then the roll back over eventually on the day closing down 112 points. But we were able to get a scalp short. I wouldn't call it even a scalp. And you get 8 to 10 points or more on a day trade on the downside. Pretty good trade, even if it's a $300 stock. Roku, same thing here. Market opened, it spiked. It got right to a resistance level at 163. And within a half hour was 152 for 11 points on the downside. Now there was a 5-wave Fibonacci retracement. Eventually it rolled over into a falling wedge and closed at 152 for a nice 10-point trade on the downside. The falling wedge is bullish, in my opinion. Falling wedges often do snap back. So you see falling wedges on Roku, intuitive surgical, more of a sideways consolidation. But ISRG, Roku, and Netflix all were 3 opportunities despite the huge down moves. Once they bounced and didn't extend the rally, it started to roll over. That was a great opportunity to short the stock. So 3 successful day trades on the short side, 2 regular stocks on the long side, and 4 or 5 ETFs on the long side, all of which did well. Now, we also obviously had a couple that didn't go anywhere, but for the most part, if you're in my room, I tell you multiple times a day, come on live. I do a webinar where I go over the charts, draw my lines, show you where support resistance is, show you the patterns as they're developing, whether they be coils, flags, pennants, breaking through out of trading ranges, whatever. But that's the signals I give when I see those things being broken and the volume increasing. Oftentimes that's a perfect day trade for our room. And there's so much opportunity every day, long and short. I wanted to give you an example of some of the things we did on the short side and on the long side at the same time. So it's a market of opportunity. And an old phrase, a friend of mine with an old phrase, it's a market of stocks, not a stock market. Too much focus. Unless you're trading the SPYs or futures on the S&Ps, it really doesn't matter what the market's doing. Yeah, you want to be in the right direction of the market if the market's going dramatically lower. But even in the worst market, the ultra shorts are going up. And there's always, if you look at the worst market I've ever seen, there was 3,400 down and 400 up. There's still 400 stocks going up. There's opportunities on the long side at all times. And yeah, it's tougher to make money on the long side in a lousy market, but it can be done, especially if you're trading ultra short instruments, which go up in a down market. So once again, I want you to take a real close look at the indices where they are, because the rollover we had here on the NASDAQ 100 and the rollover that's underway indicate the possibility that we go a little lower. But if you also, and this is what I want you to key in on, look at the declining channel, which is, it's amazing how indices and stocks follow parallel channels. It's amazing. I think Ken will agree with me that stocks tend to go up on channels and down in channels. Right now, we're down in channels, but look where we are, at the bottom of the channel. The last time we reached the bottom of the channel, we bounced smartly. Now, if this is going to be a 5-wave decline, this is a 1, 2, 3. And we're going to get wave 4. But there may be an ugly wave 5 in the next week or two, which could end this decline like it did in March. But it could be from a much more substantially lower level. Now, the NASDAQ, that was the NASDAQ 100. The S&P isn't quite as parallel because it's accelerating to the downside. But even on the accelerated channel, you're at the bottom of this channel. Now, if you bounce up into the 4590, 4490, 4500 range, where there's a really key resistance, not only at the internal trend line, which was the prior bottom in that earlier channel, but lateral price support from the lows back in November there. This is a key resistance zone. That market's going nowhere on the upside until it breaks 4,500, breaks out 4,535. Once that happens, then you have a chance of much better retracement. But for now, the trend is your friend. The trend is down, but I don't think it's going to be down for too much longer based on this. You know, the market gets too stretched too far to the downside, like we did on the oscillator here. And I pointed out to you, this is the lowest close in 2 years. We've had a very steep decline, but every steep decline here and here and here and there and there, when it reached that level, created a buying trading opportunity. So don't let everybody scare you and panic you out of your stocks down here, because even though we may be only 80 or 90% finished, it's going to happen soon. And I would suggest, if you're long something, not to throw the baby out with the bathwater, to be prudent about and not panic. Matter of fact, there may be some great opportunities out there to add to your positions if you're a long-term holder. Now, I'm not a long-term holder for the most part, and I tend to trade in our room daily and swing trades. Right now, we're much more actively day trading because it's riskier to be swing trading in a volatile market like this. But that's my take on where we're at in the market. We're extremely oversold. We may get slightly more oversold, particularly on Monday morning. But if that could create it, let's see a negative tick. Hold on a sec. This is not quite the reading I want to see, but if you see a negative tick, that gets you in the plus 1,1500 range. I'm going to show you something. Tick got to minus 1,249. Now that's a pretty steep reading, but I've seen readings like 1,400 and 1,500 negative. That creates an intraday extreme. This negative tick came there, which created that bounce. But it did close plus 226, only because there's some pre-weekend short covering, I'm sure, at the end of the day. The NASDAQ tick was minus 770, reaching 1,056. So what I want you guys and gals to watch for on Monday is an extreme negative tick, a VIX reading that spikes up, the McMillan oscillator reading that shows minus 240 to 260 or something like that. When you see all of those conditions at the same time, you get a cluster of readings that indicate extreme. That's when you go long. It takes guts, but that's the place you've got to be and the kind of mindset you have to have. Ken, we only have a few more minutes. If there's any questions, I'd like to take it to you.
Well, Harry, let me ask you a question. I traded just north of 11 million worth of orders of UVXY last year. It's my number one favorite thing to trade. And I was trading SPXU aggressively yesterday, but I love UVXY. For wash sale reasons, I'm trading VIXY, VIXY. But anyway, what I found in UVXY is you almost never buy gaps up and never sell gaps down. It's kind of opposite. Do you have any insights on, say, pre-market UVXY plays or anything, or even in market? This is the thing I love. I did 11.1 million. I kid you not, 11.1 million worth of orders in UVXY. It's did half of my entire float last year was in UVXY. So I got a little experience in it, but I really value your tips on UVXY because I think it has the single best opportunity for money to be made. I'm short the market, maybe 20 grand going into the weekend with inverses like this one. Any insights on UVXY for how to not get shaken out or pre-market trades or anything else you want to share in that one? Because I love this instrument. Look at folks, look at the 2-year chart on UVXY. Huge upside if there's any continued selling in the market.
I mean, yeah, but again, this has been reverse split 10 times.
Right.
So this is not an accurate number. It never traded at about $3 million, right? So obviously you're in a major downtrend, but what impressed me the most was the up volume on Friday. Now I think it's, well, here we had the biggest up volume ever at the top. Here we had the third most up at the top, meaning it was a 1 or 2 day wonder. So I'm concerned about the fact that if you look at the overall pattern, we're still in a massive downtrend, over the last few years. And the UVXY could be just all it's doing is running back up to that level. Now, it may create a very short window of opportunity to 1920, maybe as high as 22, 23. It implodes on Monday. But if that happens, it's going to create a great buying opportunity. Now, the thing about UVXY is very dangerous. It's very volatile. When I look at 1 minute charts, I'm always, but I will also say this, it tends to trade in channels like this. So, and I'm going to discount this stuff in the after hours. Let me take that out. You can see how it looks now without after hours. Okay. Now you see a different trend, don't you? And for me,
good point.
Right. So, because pre-market and post-market trading is thinner and can be more volatile, but it may be more dangerous. If a stock has huge volume pre-market and it's liquid, that's not a problem. In the UVXY, for example, we've got a little mini inverse head and shoulder breakout late Friday. It did carry through a little bit. But there's a cluster of resistance I'm seeing at 17.5 3/4. So the gut feel is on Monday morning, it may be up there. And if the market opens up and then reverses, this could go to 18, 19, up in that zone, maybe 19.5, 19, whatever. I don't know how far it spikes. The angle of ascent is calling for 18 3/4 roughly, the most.
Right.
If you can get $1.50 pre-market and early on, I would exit the stock because I think it's a long in the tooth. Although it has gone 1, 2, and this looks like 3. You get a fourth, you may get a fifth in the range, but I don't want to be in the fourth wave. If it gets up to 18 3/4, it could come down to 17 and then bounce to 20. So that's just theoretically 5-wave analysis.
All right, good point.
So, but pre-market is a tough one, and on a UVXY especially. I've seen it go up and down so much pre-market. It's a really tough call.
Yeah, it's the most difficult thing I've traded, but that's why I love it because I make lots of money with it. So thanks, Harry. It's a good point. Yeah.
Ken, here's the other thing I've noticed about it. I look at a low and I'll say here's support, and it violates it by that much, and then turns right around.
It's always a fake out. Yeah, you always buy the false breakdown. You always buy the low and sell the high. You buy the dip, sell the rip in this one. It's and you never buy gaps up and you never sell gaps down in this. It's completely counterintuitive, but that's part of why I like it. It's
and look at the rising channel over the last 5 hours.
Yeah, big, nice, steady uptrend. So
why, if it blows off and the market implodes, this could be up at 18.5.
Easy, yeah. All right, well, let me take this back. Thanks, Harry Boxer, so much for being here. I highly recommend, enthusiastically, of all the people in the whole industry, Harry Boxer's thinking is closest to mine. And so of all the people that run a live room, he's the only other person I recommend in the world. Harry Boxer is absolutely an ace, and you guys would do yourselves a big favor by learning from Boxer. He knows his stuff cold. We could what I like about Harry is we can finish each other's sentences. We relate more than anyone, so it's because he knows his stuff. So do I. So thanks, Harry, for being here. I appreciate it, man. And you guys go to www.thetechtrader.com. Sign up for Harry's room. You won't regret it. He's a brilliant man, and you can learn a lot from him. And I do too. So he's a great guy. So thanks, Harry. Appreciate it, man.
No problem. Thanks for having me, and I look forward to the next time. And folks, you can join us now for free for a 10-day trial. Just sign up, get into my room. You'll probably make enough money in the first 2 weeks to pay for the first year anyway.
Yeah, I totally agree with that. Yeah, Harry's good.
Give yourself the opportunity of at least seeing what it looks like, how we trade, the style we use. Good or bad markets, we tend to make money. And thanks again for being here, everybody, and look forward to seeing you in the room. Bye, everybody.
All right, and thanks, Harry. He's one of the best aces out there. He's the mechanic. He's the ace. He knows the stuff. He's the guy I trust implicitly. Harry Boxer. He's one of the good guys. He's someone I recommend to family and friends. So, All right, well, we're almost wrapping up. You guys having fun? We've got Jeff Gibby from Metastock, one of the hardest working guys I know out there, and then yours truly. I'll play a little bit of saxophone and give you my take on the inverses, especially SPXU, and I've been trading VIXY instead of UVXY this past couple of weeks as well. So let me go ahead and turn it over to Jeff Gibby. Jeff, are you here?
Yes.
Well, let's now. I'm going to make you the host. So please don't do what I did and at the end close the thing for everybody.
Okay. I won't.
I won't blame you if you did. That was my bad, but I'm still trying to learn all this stuff. But anyway, folks, Jeff Gibby, an outstanding man. He's one of the nicest and the hardest working guys out there in the industry. Metastock is a wonderful platform to use. And I wanted to turn it over to Jeff. Let me make you the host and take it away.
All right.
All right. Let me go here. 3, 2, 1. And here is Mr. Jeff Gibby. Listen to him. He knows this stuff, especially if he's going to cover the, what do you call those, expert advisors or whatever. That thing nailed it. It was on Metastock. It was really good.
Yeah, absolutely. We're going to do that again. How you doing, Ken?
Hanging in there. How you doing, man?
Great.
Yeah, good to
Awesome.
see you.
Let's try this. Let's make sure you can see my screen. And I do want to do it as a screen share. And if you don't mind, I might ask when I go into Metastock that you can see that too. Actually, I'll do that right now. So you can see my screen right now. Is that correct?
Right,
Ken?
right.
All
Absolutely.
Right, cool. It's like I've done this before. And then you can see
A few thousand times. Yeah, you're like the hardest working guy I know out there in the industry. You are, seriously. Of all the people in the trading, software and stuff for traders, you're the hardest working guy I know out there. So hats off to you for your work ethic, man.
Can you see Apple?
I can see
the chart
Apple.
now? Okay,
I
cool.
can see the MACD and I can see Apple.
Perfect. Well, we don't have a lot of time. So I'm used to talking about this in about an hour, and I'm going to shrink it down to about 30 minutes. So I'm just going to go. Ken, thank you for the introduction. I appreciate it. And let's kind of roll. I do have to read this, though. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and Metastock should have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So hope you enjoyed that. I don't have to read the other half. You can read it, though, if you want to. I'll talk a little bit about me. Again, we're going to go a little bit quick. In March, I've been at Metastock for like 25 years straight. Initially, I remember when I started, I was like, this is a really good job. My friend helped me get the job. I was like, it's probably going to last a year or two, and then I'll move on. But it's been such a good company to work for. I've just stuck with it. I really love the work that we do. I initially, when I started, I worked in inside sales. And I did that for like a decade. So if you had questions about how you're trading or what you wanted to improve about your trading, you'd call me up and I'd talk to you a little bit about how Metastock could help you with stock selection, or how you could test trading ideas and that kind of stuff. And that was a lot of fun for a decade. Then for another decade, I met people like Ken and Harry Boxer and Larry Mcmillan, and I was in charge of kind of creating products and partnerships for about it. I still kind of do that here in the US, but I was in charge of kind of creating new products for Metastock. And that's been a lot of fun for me. I've learned so much for that, working with people like Ken and all of that kind of stuff, and all of the experts. It's just been a great experience. For the last 5 years or so, I moved back to Utah. I'm now in charge of the sales team, and I do that as well as kind of a lot of webinars. So that kind of gives you an idea of what we are. Hopefully, while you're doing that, you read the introduction of Metastock here. But real quickly, we were started in 1982 by a guy by the name of Steve Akalis. I started in 97. So we had been owned by Reuters for a couple of years ago, or for a couple of years by the time I started at the company. We're not owned by Reuters. We actually purchased ourselves back from Reuters, which has been really, really good for the development of Metastock. Actually, we've been able to do a lot of stuff that we just weren't didn't have the allocated budget for in Reuters, but we still have a really good relationship with Reuters. They went on to be Thomson Reuters and then Refinitiv. And we're not going to talk a lot about what they are, but I will tell you that they're one of the biggest news providers in the world. They have something like 3,000 reporters and about 300 different global news bureaus that report to news day in and day out. And one of the things that we offer in addition to the Metastock program, which I won't even talk about today, is a product that they deliver with news. Our partnership with them is strong. We're no longer owned by them, which has actually, I think, strengthened the relationship more than anything. But we still have the ability to provide you data anywhere in the world. There's over 200 global market exchanges. If you're interested in Forex, we got it. If you're interested in London, we got it. If you're interested in India, we get a lot of Indian. Australia is a huge market for us. Singapore, Hong Kong, you name it. What I'm going to show you today and what we're going to work with today, you can power just about anything that you want to. So the one other thing I'm going to say about Metastock before we kind of get into the lesson or what I want to talk about today is one thing that we're really, really proud of. As of last year, they haven't announced the winners yet, but I have it in that we might have won again. But as of last year, we had won the Reader's Choice Award by the readers of Stocks and Commodities 28 years straight. So I love it's a company I'm happy to represent. It's software that I use every day to trade. I love the scanning functionalities in Metastock because every day I scan the S&P 600 and within 5 or 10 minutes, I know if I want to get into any stocks, as opposed to kind of having to go through 500 or 600 stocks manually. The scanning is awesome. The software is awesome. There's a reason it's been rated highly. And they do really a good job of kind of creating it. I guess I should say we do a really good job of creating it and talking about it and that kind of stuff. So one other thing, let's see. I cannot see questions. So I thought there was, oh, here we go, Q&A. If you do have questions as we go, I have questions open now over here. So I'll look over here a second every few minutes. And if you have anything that you have to ask me about or you want to ask me about, feel free. Okay. Today, what I want to talk about is trading plans, how to evaluate them, how to look at them, how to learn them, and really all of that kind of stuff. I do feel personally that having a trading plan when you're trading is extremely important. I think it's important that you understand when you get into a trade, why you're getting into a trade, why you're getting out of a trade, when you're going to get out, what your stop loss is going to be, and all of that kind of stuff should be really, really specific. One of the research that we actually do, or not we did, one of the articles I've read one time talked about professions and the best profession for trading. And when I'm kind of doing this in person, I usually ask, what's the best profession for trading? And I usually wait to get a response back, but I'm not going to do that just because of time. I'll just spoil it. It's not an engineer. It's not a psychologist, although I know some really good psychologists. Alexander Elder, Jake Bernstein were both psychologists. It's actually, though, an airline pilot is one of the best professions to have to take on a trading career. And the reason for that, I believe, is discipline. So they have rules that they trade with and they follow them. They know exactly when they're going to get in. When a pilot takes off, they know exactly when they're going to take off. They have a complete checklist that they go through. It's very, very, very disciplined. And you want it to be disciplined when it's airline pilots, right? There's a lot of people in the back of that jet. They want to get it there on point. So there's a little bit of quote by Richard Dennis. Richard Dennis was one of the original traders. And he said, I've always said you could publish rules in a newspaper, but no one would follow them. The key to trading is trading with consistency and with discipline. Richard Dennis has a really, really interesting backstory. He had well, you should look at I don't think I'm going to talk about it, but you should look at the turtle trading story up on Wikipedia. It's very, very interesting. They ended up training a bunch of people how to trade, and they made, I think it was $171 million back in the 70s with this turtle trading thing. And I'm just remembering the numbers. If you go to Wikipedia, you can actually Google Richard Dennis and they'll talk to him. What we're going to talk about today is rules. Most of technical analysis has to do with rules. And so I'm going to actually as part of what we're going to do, we're going to talk about MACD, how you can use it as a trading methodology and how it works. And kind of, I'll show you basically that in Metastock. But MACD, if you're not familiar, is created by this gentleman here. And his name is Gerald Appel. And I've actually got everything ready to go into Metastock. We had that Apple chart open. I'm going to show you, and this might be a little bit more basic if you've been around the block for a little bit, but one of the things that really surprises me over the years is a lot of people use MACD, but they really don't know how it's calculated and the way that to interpret it and stuff like that. So I'm going to show you basically that, the first thing we're going to talk about is how you calculate MACD. So here I've got a chart. And I just pulled this up, I believe, yeah, it's Apple. I thought I looked at Apple. And I've got MACD up here. I've got also a 12 period and a 26 period exponential moving average, okay? And the calculation for MACD is actually very, very simple. If I was to take this shorter period, 12 period exponential moving average and subtract it from this 26 period exponential moving average, what I'm going to get is the difference, or is the red line here. So, for example, if we did that right here, if we subtracted the shorter period from the longer period, you have a negative value, and that's why this MACD, this red histogram, is going down. That's all it's looking at. So, like if we look over here when the price of Apple is moving up, you'll notice there's a bigger difference right here between here and here, and that's what's leading to larger MACD value. That's it. So what we're comparing when we look at a MACD is we're just comparing that 12 and that 26 period exponential moving average. That's it. Now, those people that use MACD, they call it a trend. It's a trend and it's a momentum indicator. So trend, because if your shorter term moving average is going up, you're going to get more positive values. So you can read trend out of it. But also the faster that it's going out, the bigger the difference is going to be between the 12 and the 26 period exponential moving average. So like right here where Apple's moving up very, very dramatically in this phase, the difference between this and this is getting bigger, which is why we're getting a bigger value. If we have flatter MACDs, like you see right here where it kind of gets flat, that just means that we don't have a lot of momentum. We're kind of more in a congested zone. Okay, and so that when we talk about MACD, we talk about trend. It can help you analyze trend, and it can help you analyze momentum. Now, the other line here, so if we look at the red line, just to recap real quick, the red line is just the difference between the shorter term moving average and the longer term moving average. This blue line here is usually a dotted line, but I've made it blue, and I've made it bigger just so you can see it, so it's no longer dotted. But all that is Gerald calls it the signal line. And it is basically a 9-period exponential moving average of the red line. Okay, so that's all it is. He calls it a signal line, but basically all it is another exponential moving average that he throws on top of the thing. So the reason he calls it a signal line is we use it to measure whether the MACD is bullish or bearish. Okay, and so what I mean by that very, very specifically, if we're looking at the relationship between the MACD and its signal line right here, you can say up until this point, the MACD for the most part has been above its signal line. Right here, it crosses and starts to trade down below its signal line. Okay, and I'm just going to draw that part of the chart. Right here, since it's trading below its signal line, the way that you would read the bullish or bearish state of MACD is since it's been on below its signal line, right now the MACD is bearish, which means that we anticipate Apple will fall in price. Okay, doesn't always happen, and in this case, it did eventually start to happen, but it did stay sideways for a while. But that's the way we would read it. Okay, if we're trading up above our signal line, as we were from pretty much, it went from right here to right about here. There's a point where it was down underneath for just a few bars here, but as long as trading above its signal line, we're going to call it bullish. And that would mean that if we're kind of trading based on that signal, that we expect Apple's price to rise. Okay, so now with Metastock, we actually have the expert advisor that Ken was talking about. And what that allows me to do is it allows me to learn about different methods. So if I came in here, open up my expert advisor, I'm going to pull it on the screen. You should be able to see in Metastock, there's about 40 different methods that are available. And there's a bunch of them that I like to show, like there's one that shows what the candlestick patterns are. But what I'm going to do, because we're talking about MACD, is I'm just going to go to go down here on the list, I'm going to find MACD by Metastock, and I'm going to attach it to the chart. We're going to go ahead and close it. And you can see where I've drawn these buy and sell, these horizontal lines. Pretty close to that, you're going to get either a MACD buy signal or a MACD sell signal. You'll also, I'm going to pop this here because I prefer to see it here. You'll also be able to see when that MACD is bullish, when it's in a bearish phase, or when it's in a bullish phase. So it's drawing that on the chart for you. One of the things I absolutely love about technical analysis too is it's very objective. So, I spent a couple minutes talking about MACD and how it's calculated. You'd understand that why you're getting this sell signal. It may not work every time, but you understand very objectively that it's because you're basically getting a crossover here and the MACD is going bearish. And you expect if a pullback in price, okay? If we would have sold here, it would have went down against us for a little bit and then eventually pull back. We're probably in a profitable trade here, but since this is objective, I can see that on a chart. Like, so for example, if I bought here and I sold here, I know that's a successful trade. If I sold here and bought here, not so much maybe. If I bought here and sold here, maybe a little bit, this would have been a good one right here. I can very visually see how well this works. And because it's objective, I can also test it. But before we get to testing, I do want to show you two other ways. Well, yeah, we'll do two other ways to look at MACD. The other way that you can measure MACD, since it's looking at momentum, is as an overbought or oversold indicator. So the idea being, if MACD stretches, if momentum stretches, you might have a pullback or a reversion to the mean, okay? And that's something that Gerald talks about a lot in the MACD book, in the MACD work that he's done, is you can use it as a reversion to the mean indicator. Now you'll notice right here, because I'm going to point it out, that most of the time the bars are either black, but there's a couple times if you look at the chart, right here it gets red, right here it gets red, and those are the only times. It might get green as well if it gets significantly oversold. But in this case, it's getting significantly overbought, and Metastock is actually showing that's on the chart. What I'm going to do is I'm actually going to open up a commentary window and just kind of show you what Metastock will tell you on that day. So if I click on View and I go to Expert Commentary, you're going to notice right here, there's a bit of a triangle that's pointing down. And it's just going to give us an update on currently what is happening in MACD. So we're looking at this bar, okay? Currently, the MACD is bearish since it's below its signal line. The MACD crossed below its signal line 22 days ago. Since the MACD crossed below its moving average, the price has decreased about 4%. And here's the high and here's the low. Right now, it's not reading MACD as an overbought or oversold. And right now, it's not seeing divergence, which is the third thing I'm going to talk about real quick. Okay. Now, if I was to go back, I'm going to just move that arrow back. I can analyze this day. It's going to ignore all of this data and it's going to tell me what it talks about here. I'm going to make this a little bit bigger for you just so you can read it a little bit better if you want to follow along in your books. You'll know it's never mind. for kids of the 80s, you know it's time to turn the page. Yeah. So you can see the MACD is on an overbought range. Now here's the trick about overbought though. If you follow stocks can be overbought for a long time, right? They can continue to be overbought. That doesn't mean that they're necessarily going to turn around. And we warn you about that. So like we say right here, prices may continue to move higher for some time. Wait for prices to move lower before you consider going short or exiting the trade. In this case, we did a pretty good job of calling that as the high, but it doesn't always happen. This one looks good too. I was going to try and find a bad example. But if I'm looking at this and I'm in a long position that's profitable, I might consider moving up my stop or something along those lines. So that's the way kind of MACD works. Now this is just MACD, and I'm looking at the time going, I'm not going to kind of abbreviate a lot of things, but there's about 40 systems built into here. So like if I wanted to, for example, I'm going to come in here and I'm going to attach this candlestick to the chart. And what we're going to see, I do feel like I need to change this to candlesticks if we're going to be looking at candlesticks. But what this one is going to do is it's going to identify any of 30 different candle patterns. So here we had an engulfing bull, we had an on neckline, we have a falling window. Here's a rising window, a rising window. All these 31 patterns, when they show up on a chart, you can look at, and they also have commentary. So for example, if I want to see what this rising window meant, I can go to that day and it's going to tell me a rising window occurred. This is where the top of the previous shadow is below the bottom of the current shadow. This usually implies a continuation of a bullish trend. There have been 3 rising windows of the last 50 candles. So I love the expert advisor. It's really cool in terms of helping you understand what a system is doing. It does a really good job at that. One of the questions I would get a lot back when I worked in inside sales is, okay, so there's 40 or 50 methodologies that are built into Metastock. How do I understand how well they work or how they compare? Maybe Bollinger Bands isn't the best one to use for Apple, or maybe using these candlestick patterns is good as a confirmation, but I want to understand how things work. And with one of the things that we have with Metastock to kind of help you understand and kind of narrow down on that curve is a system tester. And so just to kind of keep this real quick, what I'm going to do is I'm going to go to our system tester here. And here I've got about 75 different systems that are built in here. But let's just go ahead and do these adaptive cycle toolkit ones. And I'm going to go ahead and just pick these. If I wanted to compare all of them, I could. And just run all 75. Due to time, we're not going to. And we're just going to do Apple. But I do want you to know with our system tester, I think it's one of the best in the business. Like I can go in and I can test all 75 of these systems against all 5,000 stocks and really get a good idea of what works well. It's one of the most powerful system tests I've seen out there. So, but in this case, I'm just going to test these ACT systems that come in Metastock. These are based on the work of John Ellis, just to kind of give you an idea very quickly of how it works. So I'll go ahead and start the system test. It's going to go back. It's going to take all of those systems. It's done. It's going to tell us how well they worked over time. So it's already done. Now, if I'd done 5,000 stocks and 75 systems, it would have taken 45 minutes, which, you know, I'm not going to go into Ken's time or anything. So let's go ahead and click on view results. You kind of, actually, it's done because it didn't take any trades on that. So something was messed up in the settings, but normally what it would do is it would come back and it would tell me how profitable something was over the last year. Something's really kind of just off in here. But I don't think I have time to drill into
I think it's your ticker should be AAPL.O.
Oh, tech support here. Thanks, Ken. That's
Sure thing,
that
man.
would make a difference. Okay.
That'll do it. Yeah.
yeah. So we're at it again real quick. It didn't take any longer. Hopefully, I got it right that time, right? Ken, I'm going to send you, I don't know, something. Anyway, so here what we've got is we've got the systems. This one traded about 9 times last year, 15 times, 43 times. You can see how much money they would have gotten. Our best performing was 18% on Apple last year. So you get a really good idea of what this allows you to do. Is it allows you to, if this is something that is a system that comes up all the time, you could go learn about this. I don't recommend it as like, you should know why you're trading. But if I'm testing 76 methods, I want to focus on the ones that are working right now in the market. And so this allows me to do that. In fact, because we have the ability to test multiple ideas against multiple stocks, it's going to give you a really good idea of how it works over a broad instrument of things. The other thing that I'll just mention, and I did mention it already, is scanning. Now, scanning is something that I use every day in Metastock. I think it's one of the most valuable tools that we have. And I'm not going to show you a scan. You'll just have to take my word for it. But I run it. I'll come in we're in Utah. And I'll come in at 1:45 usually. The market closes at 2 o'clock here in Utah. I'll take a look at the positions and see if I need to get in out of anything. I'll very, very quickly run a market scan and just be able to see if there's any new positions or any new charts I want to look at. And for me, it allows me to continue to do my job because I'd have a tendency to just trade if I could. But it also allows me to kind of stay involved in the markets. And everybody knows at the office that 1:45 is my trading time, so don't bug me for a minute. So, in fact, I keep it busy on my calendar. So, in any case, somebody's calling me. Okay, so what I'm going to do for you guys today is we'll go ahead and kind of do this. I'll talk a little bit about pricing, and then I'll let you guys get on with your day. What I want you to do is I actually want you to try Metastock. And I'm going to give you an offer I don't give very often, and that's just the ability to try it for free. So we have 2 versions of Metastock. We have a DC version, and we've got a real-time version. Our real-time version comes with that news platform that I was talking about that's been rated, well, that was spent, that they have all that news in, and it's really good. It's literally the same package that hedge funds and institutions use when they're getting data from Refinitiv. So we're going to include that. We're going to include the MetaStock program. It's $250 a month normally. We also have a DC version. With DC, what that stands for is daily charts. It's end of day. It's only $69 per month, and you can try it as well. With the free trial, what I'm going to do is I'm going to give you MetaStock 17. I'm going to give you all of the data you need to try it. I'm going to have somebody give you a call and spend up to 2 hours on the phone walking you through how to test trading ideas, how to use the scanner. We started doing, we call it a white glove support. White glove support, installation support is what we call it. I had to look at the chart, I forgot. But we'll literally have somebody walk you through how everything works. We'll also give you some home training courses that kind of go through some of our favorite systems and how they work. That's normally a $99 value. See, I would just want you to try it. There's a reason it's been rated #1 for like 28 years in a row. And if you try it and we help you get it set up and you use it and it's helpful for you, it's going to pay for itself. So to sign up for that, you could go to metastock.com/DTU. That'll help you get set up. You can call 800-882-3040. And you can also visit metastock.com/saleschat. One of my sales guys was just calling me. So I think he's actually working because he's got a question. So if you have questions or you want to get some more information about the software, give it a go. I wouldn't trade without it. It's helped me trade successfully year after year after year. And so I want you to be able to try it. If you don't like it, you can cancel it. It'll be okay. But give it a go. There's a reason it's been rated highly. Try it out. See if it works for you. That's what I got, Ken. I managed to quit early, actually.
Well, thanks so much, Jeff Gibby and MetaStock. Highly recommend it. You know that MACD Expert Advisor alone is worth getting that for, because you could have made a fortune or made a lot on Apple, right? That was a really good setup.
Really good trades. The funny thing is that MACD Expert, when we actually do the tests, like all 76 of them, usually it's like the 15th best performing one out of those.
Wow.
So that's why I think it's important to test ideas. It's just to, so you can, so we could spend 40 minutes talking about MACD. I've done it before, but the idea is to focus on what works the most effective, right?
Right. An outstanding platform, and great job. You know, it's a really good having you here as always. You did a super job presenting the platform, and looks good. So thanks to everybody for being here so far, and thanks Jeff Gibby from MetaStock. Do sign up at www.metastock.com/DTU. And I'll see you next time, Jeff. Thanks for being here, man.
Thanks for having me. Always happy to be here.
Thanks. Yeah, good to have you.
I'm gonna. Do you want to just boot me? Is there a way for you to boot me so I don't shut down the room? I'm worried about that.
Yeah, I think we've got it. Let me try and get this. Going.
There's a leave option. That should work, right? Leave.
Yeah. I'm trying to share my screen here, but it's not letting. Okay, here we go.
I can stop share if that helps. Do I need to make you host again?
No, I think I did. Let's see. Okay, can everybody see?
We can see your screen.
Okay. Well, thanks, Jeff. I appreciate it. And you can stop sharing your video, and hopefully mine will come through, and we should be in good shape.
All right, sounds good. Thanks, Ken. Appreciate it.
Thanks, Jeff. I appreciate it, man.
Have a great one.
Yeah, you too, man. Thanks. All right, traders. Well, what do you think so far? It's been a really good session. Hopefully, all have picked up some useful ideas from our presenters. Really pleased to have so many people here in our event. So what do you guys think so far? Has it been good? I think it's the best summit I've had so far of all the ones we've done the last several years. But I picked up a lot of good tips and techniques myself. I always learn from, I only choose really smart people and know what they're talking about because I want to learn too, right? So it's good. You guys pick up a lot? Let me know. And we will get underway here. So we're going to take a look at gaps and breakouts. I want to start by looking at some of the very strongest charts out there. One of the things that, let me start off by, of course, my cursor is on the fritz here. Let me reset this and we'll be good to go. We have great opportunity, right? Great opportunity coming up with volatility in the markets racing up sharply, and we've got some really good charts to work with. So we're going to be looking at those coming up. Let's take a look by looking at SPXU. I know Harry had mentioned this one. I was trading this aggressively on Friday. The inverse instruments, whether you trade UVXY, I'm trading VIXY right now, kind of same pattern. The SPXY, the SDOW. One of the first tips that I'll share with you, and before I get started, let me just share with you that I do actually really trade a lot. I'm trying to get my browser window up here for you guys. Here's my website at Trade Mastery. You're welcome to sign up for my free Saturday webinars when we look at live videos. The thing that I wanted to share with you is down towards the bottom of the page here. If I can scroll down, and let's see. Okay, just to share with you proof that I did over $23 million worth of trades. This is for my Fidelity account. I did $23 million worth of trades last year alone. So I'm a hyperactive trader. I do day trades anywhere from 60 to 80 daily, as little as maybe 20 or 30 on a light day, but close to 100 on a busy day. So I am the real deal with P&L proof that I actually trade. I'll show my 1099 like I did earlier once I have it from the good folks at Fidelity. So I'm the real deal. And I think that's important when you learn from people that actually trade and know their stuff. One of the first tips that I'll share with you is focus your energy on out charts, charts that are above the previous day's high. If you swing trade, make sure that, you may have seen my award-winning Stocks and Commodities magazine articles. You want to scale in like I did. I bought some more of this on yesterday into the aftermarket, I think it was. If something closes the day at a 2-day high, somewhere above the previous day's high, you scale in or you initiate a new trade. If the thing that you're swing trading is inside the previous day's range, that's a hold. You don't buy or sell, you just hold. Just like those old analyst ratings, buy, sell, hold. You buy if it ends up here, you hold it here, and you start lightening up. Sell at least a third to a half of the position if it ends the day down at a 2-day low. Let me ask a quick question. How many of you are familiar with and or trade the inverse instruments? A really good one that I have traded for years is TZA. And if you take a look at the daily in that, let's take a look at 6 months. It's a Russell short. It's got a spectacular swing trading breakout to the upside. Now, are we late to the party? No, we're not. If you look at it in context, and this is where I expect to at least triple my trading accounts this year, is shorting the market by being long inverses. Harry mentioned them. I mentioned them. Anybody that knows how to trade should be talking about inverses. Let me ask you guys a question. I am deeply suspicious and cynical that the talking heads whack, 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 whack on talking head TV, on cable TV, I won't mention the networks, will never tell you guys. I used to call these Wall Street's best kept secret. They will never tell you about inverse ETFs. Why is that? Can someone tell me? They're all doing stupid talk like, oh, it's oversold, so go ahead and buy. No, if it goes down, you sell. If it goes up, like this guy, you buy, right? Can somebody tell me, please, if I was talking to the head of programming, why don't the talking heads ever talk about inverse instruments? Because during the March sell-off earlier, look at the split adjusted price. And Harry had touched on this, and I touched on it too, is record high volume recently in the inverse instruments. Buku upside, right? Lots of opportunity in our inverse ETFs if they go up. Does anyone have any idea? Let me know if any thoughts on why won't the talking heads talk about that. Let me open the chat box here and see what people are saying. Okay, good to hear. Oh yeah, hey Mary, yeah, talking about inverses. Degenerate's saying very risky. Yeah, that's true. For mom and pop home investors and people that aren't traders, they are highly risky. For investors, you don't invest in inverses. They're mostly for day trading or short-term swings. One thing to look at, by the way, I shorted the market on Friday. I was already in, I want to say maybe 9 or 10 grand worth of inverses the last 3 weeks, actually since late December. And I almost doubled down yesterday. I bought maybe another 8 grand worth of inverses, so still small. I'm not doing 70, 80 grand worth of inverses yet. So I'm just nibbling like Pac-Man, just maybe 20 grand worth of inverses. Now that could bite me in the ass. We may get a gap up in the market. One thing to not do this is a very critically important, again, this is all for educational use only, I'm not making recommendations. One thing to not do is be faked out by bounces in the market. You sell into any buyers next week, absolutely. This would be a really stupid time to buy stocks. Even if they look incredibly cheap, they'll probably get a whole lot cheaper before all said and done. I called crypto short at 42, and now I think it's at 34 or something, so I'm good at understanding where these things are likely to head. So anyway, we take a look at our 6-month chart. Kind of zoom in on the 6-month daily candle. This is a nice recovery play. What I like is, and again, here's another quick tip. When you're looking at MACD, or I'm sorry, when you're looking at moving average crossover, I was thinking MACD from Jeff's excellent presentation. That was impressive, right? The MACD expert advisor on Apple. You could not have lost with those signals. Anyway, I don't think you could have. Anyway, look for 3 days or more in a row to define a trend or a breakout. Do not get in at the very first sign. Well, I had to say, get in small size in the first sign of a move, but do play it aggressively only once it's gone 3 days or more in a row. So for example, TZA, a nice run up off the 25, now it's up at 38. It could easily get to 50 within a week or so. So, yeah, good. So Mike's asking, why don't the talking heads talk about it? I don't know. I do not know for the life of me why the talking heads, they won't tell you about buying index puts, right? For 0 DTE, if you're doing Monday, Wednesday, Friday intraday SPY puts, they won't tell you about that. They won't tell you about inverses that go up. All they do is, don't cry about the market going down. Guys like me are professionals. I make money on the market down. I was up $700 yesterday, right? Not a lot, but still it beats a kick in the nuts. Almost $1,000 yesterday. So I make money when the market goes down by playing inverses like this. Now, here's another quick tip. There's a whole boatload, I won't use cuss words, there's a whole boatload of inverses. When it comes to deciding which ones to trade, there's some that are fairly well known. Let's say SDS, QID. One that I really like is the short Kathy, well, I won't mention her name, SARK, S-A-R-K, Short Technology. It's a recent IPO designed to go the opposite direction of Kathy's fund. Look at the spectacular run in SARK. I was calling it long for my traders at TradeMastery.com, starting at 34 on the first breakout. And it's gone up almost, 14 points from there. This is the short technology, SARK. When it comes to evaluating which of the inverses, I used to trade, I'd be in like 8 different ones, and I've calmed down a bit in my older age. I like to look at the leverage or the percentage change delta. Successful trading is all about directional volatility and trading ranges. So one of the things that you want to look at, I'm long techs heavy right now, TECS. It's another way to short technology. Look at the volume. And look where we're at, 27, 28 up to 38, 40. And look at the volume. Look at price action plus volume equals directional moves that make sense to trade. So I'm long TECS, at least a few hundred shares, and other inverses. When it comes to, back to and LabD has been really good too lately, right? Biotech inverse. I'm an expert at inverses. I'm one of the guys that you want to learn from. Me and Harry would be the 2 people I would learn from for day and swing trading during these volatile times. Look at LabD. This is how to short biotechs. Now, I've been telling my traders about this guy since 28.30, right? Right at that bullish inverted, kind of head inverted reverse cup and handle. It's a handle and a cup. Anyway, the point is, it was long over 30. And I called it for my traders there. One of the reasons is a really good directional move off the initial base. Volatility tends to repeat itself, right? So when you're looking at these charts, trying to find some way to get stamps. When you have 3 moves up, this is a nice top. One thing to look at too is the decade values. The multiples of 10. You may have seen my articles in Stocks and Commodities or my Money Show presentations where I talk about buying right above buying 21, selling 29, buying 31, selling 39. Trade within the decade values for these instruments. Here would be the buy 31, sell the 39, or tighten up a trailing stop. Then buy the 41, exit target would be up near the high 40s, near 48, 49. Use it like a logarithmic curve. The further something gets closer to a multiple of 10, the tighter you should trail a stop, because often I've taught tens of thousands now traders to sell the nines, right? That's one of my articles in Stocks and Commodities magazine is something like never buy nines, right? And one of the more popular articles, and that's a good reason. Let's see, question from Mike. I mentioned change in delta. What information indicators monitor the change? Good point from Virginia saying talking heads are scripted and most do not trade, just talk and mislead people. That's true. That I agree with that. Talking heads talk, and that's what they do. Us traders, we trade. Some of us talk too, but I trade 23 million worth of order flow last year. That's my previous record had been 4.9 million. I've got a screen cap of my 1099. Did almost 4 times that last year. So think how much money you could make. Now, here's another quick tip. Every single order that you make should be a one triggers the other conditional order. And I don't have a screen cap handy, but I use Fidelity because I like no commissions. I spent 30 grand in commissions over a year and a half, a couple of years ago. This past year and a half, 0 in commissions. Boom. It saves money. Anyway, use one triggers the other. OTO conditional orders with either trailing or hard stops. And without going into painful detail on that, basically you set up your trade ahead of time. And what I do when I'm day trading, which I do every day, is I put in a sequence. Let me get rid of the annotation here. Clear all things. Get rid of that. When I'm day trading, I always set up. I do this much more in intraday than for swing trades. But for example, I was trading SPXU both yesterday and the day before. What I will do is I will put in a sequence of trades ahead of time because, like some of the other speakers mentioned, we don't have any idea when things are going to go up or down. All we have is our trading plan and our trade management strategy. So, a big turnout. Thanks everyone for being here. So what I do every single day, starting pre-market, I start following the market like 5 a.m. My time, 7 a.m. East Coast time. I'm looking at charts 2.5 hours before the bell. I will put in those OTO orders for a sequence of trades, maybe every 20 or 30 cents. So I'll build a rack of trades, 4 or 5 trades. And I use a combination of both trailing and hard stops of no more than 10 or 12 cents. Often I'll do 400 shares with a 6-cent trail stop. And sure, half of them get shaken out. But the ones that work out can do extremely well. So what you want to do is whenever you intraday trade, what you don't do is what I did back in the the late 90s when I first started day trading, back with Daytech. Does anyone remember Daytech with 60-second order fill guarantees? I'd make the big trade decision. I'd be sure to check squiggly lines, and I'd be sure to make sure it's a big bump decision. What I've found since then is that's completely the ass-backward way to trade profitably. My most profitable years and months and days and weeks and quarters are always those in which I do what Sosnoff says, trade small, trade often. So I'll put in a series or a sequence. This is foundationally important for your success as a trader. I'm the real deal. I actually really trade millions of dollars worth a year. Every single trading decision should be a sequence. I know Kramer gets to this a little bit. It's don't make all or nothing trades, and that's exactly right. Break your trades in 2 or 3 at least. So instead of a 500 share trade, I might do a 200, a 200, a 100, something like that. Or when I'm doing day trades in this, I always do, say, blocks of 300 to 400 shares, as little as 200, but usually 300, 400 shares every 20 cents or so. So that way I build the trade. I'm often in 1,600 shares, but never from the get-go. I start off like a Pac-Man approach. I put in a sequence of trades. This is true for your swing trading as well. It's vitally important that you do not bet the farm on any one trade because you're going to lose your ass. Here's a sobering insight. Neither I nor any professional trader nor anybody in the world makes more wins than stops. You, for the rest of your life, and me too, all of us will have more stops than wins. One of my most profitable years, I was wrong 74% of my trades were stops, but I made more on the wins than I did on the stops. Taking itty-bitty tiny stops and take lots of shots is much better than taking large shots and hope that your analysis is right. All we've got, I mean, I don't need the headphones anymore, so that's good. No one else presenting today. It's been a long day. This is vitally important that you understand this. You are going to be wrong more often than right. There's a lot of bullshit educators out there that say, I've got a system that's back-tested to 71% correct. Well, show me your P&Ls like I show. Show me your tax return proof, baby. Show me your 1099s. Show some proof, right? And you'll never see it. The truth is, you will always be wrong more than right. The challenge in front of you is to make more money net, being right a percentage of the time than you are wrong in your stops. My average stop loss cost, again, I do anywhere from 60 to 80 day trades daily, is well under $20. I may take $8, $12, $15, $30 stops, a lot of them, so it's the death of a thousand cuts on red days, but on green days, I make it up with larger wins. So I may make, $80 on a win or 20 or 30 on a stop. And I do a lot of different trades. So you may want to adapt that thinking approach. The main thing is every trading decision should be seen as a sequence of 2 or 3 trades. That's vitally important. You have my word. It's very heartfelt. If I can help you make money, then hopefully you want to be one of my customers, one of my many traders in my live room and whatnot. But test out my free stuff first and see how well it works, as it has for so many thousands of traders that have given me testimonials and industry awards and all that. You have to learn how to do a sequence of trades. That's vitally important. That's the most important thing I'll teach you. And that and the fact that range is more important than anything else. On the chart, the most important feature of a chart, curiously enough, is not the data points in the chart. It's the right side of the chart, the range of the chart. Is this thing worth trading in the first place? For example, I called Netflix short yesterday at $397 for my traders. And also, I went long at 386 here and sold, I think, right at like 401, 402. Anyway, I traded the bounce, boom, in Netflix, right? I didn't short it because I don't usually short equities, or very seldom. I tried shorting Carnival unsuccessfully recently, but in general, I just go long stocks. But range is everything. Is this thing tradable? Absolutely. Maybe it gaps up to 415, runs to 440 on sometime next week. Maybe it gaps down to 470, runs down to 455. We can't predict. All we can do is react, right? Any professional trader will tell you that. And you look at range instruments, like Harry mentioned also, great minds think alike. We're covering both of these for our traders, Netflix and Peloton. I'm also keen on Ford if it ever comes back to life, but PTON was a nice inverse head and shoulders over the 26, right? Ran all the way up to 28. This illustrates another concept, and I've only got a few minutes left, but that is the power of whole numbers. Never ever buy anything with a 9 in it. That would be a really stupid idea, right? Because often it'll stall out at the whole number. So if you take stops, remember to purchase right above a whole number, like 2620 or 2720, sell the 2780 kind of thing. So trade within, just like the multiple of 10s for swing trades, for day trades use within dollars. Now you shouldn't just cash out just arbitrarily because it's getting close to a whole number, but at least tighten your trailing stop to within a dime or so. That's what I do. Once it goes, let's say I buy 27.30 and it's up at 27.92, I'll tighten up the trailing stop to like 27.80, 85 to book a profit. Well, thanks, Quadam. I appreciate it. Hey, Mick, and thanks for the tip on the mic earlier. Yen and Yang may be interesting too. Yen versus Yang. Hey, another quick tip, and this is good for trades as well. Harry mentioned Boyle. One thing that you want to do is that I like is I was trading cold. See, look how cheap SPXU is, right? Or I'm sorry, Peloton. Anyway, let's take a look at KOLD. That's the inverse. I was trading this back in December on the bounce. Back in December on the bounce, it split adjusted. It used to be like 11 to 13 back in the base. I called along for my traders on this chart it'd be around 30, 35, but they did a reverse split. Back a month or so ago, it was a third of this. Anyway, cold versus Boyle. The only guarantee that we have in the market is that the inverse related instruments will trade opposite of each other. For example, say TNA. TNA is that chart pattern. That's the Russell Long versus TZA. which has the exact opposite pattern. A good advanced technique. You may want to read my article on stocks and commodities, what I call ETF arbitrage trades, is you can do both swing and day trades by trading the opposite against the directional chart. And that's a really smart idea because you can start off, how to say, it's the one and only guarantee that I found in the stock market is that the directional instruments are guaranteed to be opposite of their inverses, right? That's the only relationship, and we can exploit that carefully. I teach how in my live trading room, right, at trademastery.com. A little plug there, www.trademastery.com. I know this stuff cold. I've been doing this for 20 odd years, full time. That's what I do. Anyway, you may often have heard the idea of a trading edge, and you're always looking for opportunities to capitalize on things that give you an edge. Only trade strongest charts, right? I think I've got signs saying stop over trading, no trades after 10:30. I have another sign somewhere that says best charts only. So good stuff. When did I publish the article? I think it was 2 years ago, Mike. It was back in 2019. But just look up the word arbitrage in ETF arbitrage in stocks at traders.com and stocks and commodities. That's a good article. Anyway, the point is you could put on trades both. It's like kind of going long and short at the same time, but then you can scale or position size in the one that's working out. Now the trick is doing that without getting shaken out on the pullbacks and the rest of it. And I teach how to do that as well. So anyway, lots of good stuff. I am pretty much exhausted, so I'm going to call it a day. I wanted to thank all of you for being here. Hey, it's over that quick. Because I want to play saxophone a little bit. So it's, again, commissionable trades. This is proof. Back when they were charging commissions, I paid 29 grand in commissions to Fidelity, and happily so, right? Very happy with my trades. Anyway, the point is, most of the educators out there are not experts or they're not real traders. I'm a real trader, and hopefully I've shared with you some ideas. Remember, don't trade within the previous day's range. For proof, go back over your last 50 trades or 20 trades or whatever. Never, ever, ever day or swing trade in charts. And also trade light size or avoid trading inside market days. If yesterday's range in the S&P is here and it's opening here, thou shalt not trade. If a chart that you're interested in traded this range yesterday and it's here, thou shalt not trade. Only buy small gap continuations above the previous day's high. That's one of the best pieces of it. I won't say advice, but lessons learned that I learned the hard way, of course, is don't trade things inside the previous day's range. And the reason is high frequency trading algorithms. I used to have a lot of the market makers and specialists and the Wall Street gang would come to some of my live day trading seminars in Las Vegas that I did at the MGM Grand Hotel. It's kind of like spring break place. It's fun. And huge conference rooms. Highly recommend it. If you need meeting space in Vegas, MGM Grand. Anyway, the point is I'd hear the inside tips from these guys when I did the live seminars in the hallway or after hours. They would disclose a lot of stuff to me. HFT algos, the Boolean operators, use OHLC data, right? Open, high, low, close. I used to be a statistician for Ford Motor Company. I'm a UCLA graduate. I've put a lot of work into my life in trying to help traders beat the market because it's very frustrating and very difficult and very disappointing when you're on the wrong side of your trades. By putting some simple technical fences in place to protect your capital, like don't trade inside markets or charts, don't trade narrow range instruments, do a sequence of trades versus all or nothing trades. All of that kind of stuff can help you become potentially a better trader. So I hope that helps. I want to say thanks to all of you for being here. I'm going to wrap up. Oh yeah, my last call to action was what? We've got some call to action in here somewhere. Well, just go to trademastery.com. You may have seen me anywhere from Fidelity to all over the place. And for proof, you can see links on my website. You can go to trademastery.com/live for my live room. It's the live room experience. You can also sign up for my free Saturday webinars. And the Zoom link is on the front of trademastery.com. So like Barry said, don't have to spend anything with me on the front end. Just get accustomed to my Saturday events and we go over hot charts and techniques and answer questions and the rest of it. So let me wrap up. Please give me an honest answer here. On a 1 to 10 scale, how would you rate today's summit? I I mean, I loved it. I learned so much. It was worth doing. It's a lot of work to put these shindigs on, as you might expect. But I got a lot out of it, and I got a lot out of you guys being here. On a 1 to 10 scale, how would you rate it? I'm seeing 10, 10, 10, 8, 10, 10, 10, 10, 10, 10 plus, 9, 10, 10, 10, 20. Okay, thanks. 9, thanks, Ken. 10, 10, 10, 11. Thanks a lot. Hey, Gerald. 10, 11, 8. Hey, Tony. All right, well, thanks, folks. I sincerely appreciate your time and your effort. I hope that I've been of value to. I hope that the insights, I highly recommend everybody here. If I didn't, I wouldn't work with them. I'm very honest. At this point in my career, I get the call, from folks, and I only work with people who I trust and respect, all of which certainly fits the bill for today's winning presentation. So thanks so much to all of you for being here. I'm going to stop the recording. You guys can take off if you want. I'm going to play saxophone for a little bit because it's one thing I do. If you want to see my saxophone videos, go to www.tradingjazz.com. And I've got lots of videos I made from jazz, mostly jazz classics and blues and all the rest of it.